kind of see shades of this K-shaped economy, K-shaped market.
Instead of any sort of dramatic surge that could reignite inflation pressures, we will see hiring activity slowly start to pick up.
If employment keeps weakening, if inflation kind of stays somewhat cool, it's hard to imagine that the Fed doesn't cut more.
What matters is how the interplay of the risks and the tailwinds are going to interplay in 2026.
2026 is really about adaptability.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to the final trading day of 2025. Stocks on track for a fourth day of losses in light trading as investors lack a catalyst to get off the couch. Jobless claims on deck as the final economic indicator of the year, with yesterday's Fed minutes highlighting more rate cuts to come in 2026, and gold and silver very much in focus again, with the CME raising margins on precious metal futures for the second time in a week amid heightened volatility. John and Annmarie are enjoying a well-deserved holiday. We're holding down the fort here in New York, looking back on a pivotal year for markets, policy, and politics. And just to let you know, it is already New Year, at least if you're in Auckland, New Zealand. We're kicking off the New Year's celebrations. We'll be heading over to Sydney, Australia next, then Tokyo and Seoul and Beijing. Before the day is out, we'll have Paris and London full New Year's before it hits New York City. Just taking a look back at the year in markets, it's been a wild ride. Many superlatives. Another double-digit year for U.S. equities, the third in a row. Bonds and stocks both delivering pretty significant gains. The dollar weakening at the fastest pace since 2017. We saw the biggest year for gold and silver since 1979. We also saw the worst year for oil since 2020 on supply gluts. And we saw the best year for Spanish stocks since 1993. A key question heading into 2026 is, will the rest of the world continue to outperform the United States? In the bond space today, you are seeing a bit of a bid in. Yield curves have steepened throughout the world as people face off with inflation and government debt. Right now, we are ending with a bit of a whimper. We begin the day with stocks poised for a fourth session of losses. Right now, looking at just this slight decline, and really led by what we've seen in the NASDAQ with respect to losses there. And right now, you are seeing a decline of about 0.4%, leading losses. A question going into next year will also be the rotation trade, and we'll continue to see it in the bond space. That yield curve steepening has been the theme so far for the year. You see that continuing this morning. At the front end, you have 3.44%. That is down from 4.23% to start the year on the 2-year. 10-year yields at 4.11%. They started the year at 4.55. 30-year yields slightly above where they began this year, 4.77 to start the year, 4.79 to close out. Coming up this hour, Michael Purvis of Talbot and Capital Advisors. As stocks pare back a strong year of gains, George Pollack of Signum Global with healthcare costs set to jump for millions of Americans with the ACA subsidies expiring today. And Michael Reed of RBC as investors eye one last read on the labor market for the year. We begin this hour, stocks cutting into gains of more than 17% for this year. Michael Purvis of Talbot and Capital Advisors writing, the biggest threat to the S&P next year is that AI spend will be considered not to generate compelling returns. This means multiple contraction for a key part of the market. Michael joins us now. Michael, thank you so much for being with us. Happy New Year to you. Let's start with this idea of how much AI has really upheld the rally so far this year. Can you take a look back and give us a sense of how dominant that theme was and how that might be poised to shift in 2026?
Well, Lisa, if you look at the sort of large tech relative to cyclical and value pair over the last, not year, but the last 6 or 7 years, that line goes up to the right, just like the overall market does. It's sort of one and the same. And what I've argued for years now is that the big tech rally is kind of the broader SPX rally. There's just consistent outperformance in almost every year, except when you have bear markets like 2022. And even then, it wasn't really that ferociously sold off there. There's very good reasons for that, which is that they generate not only a superior quantity of earnings, but the quality, meaning the volatility of those earnings, is remarkably low. And so compared to cyclical and value earning streams, they're just a lot more superior. What I'm really, the question I think that I have as we look into 2026 is that you have these giant companies, you have, Microsoft, Meta, Amazon, and so forth. All of them have very distinct business models. And many of these companies are really now converging in a very massive way on this AI spend, which is they're taking their business models from a very distinct place almost to a somewhat similar place in some respects, right? We're talking about $1 trillion of cash out of 4 companies over the next 24 months here. There. So just to finish the thought, Lisa, I think that the question that I'm really asking is that if the return on invested capital is not there, and if you look at the free cash flow yields on stocks like Microsoft, they're at record lows right now. So the price earnings and earnings growth ratios look very compelling. The free cash flow is the problem, and so it all works if the returns are there. But if it's not, you're going to see a real re-rate in the big tech pillar of the market.
Is there a signal that you're getting, Michael, just to sort of build on this idea from the race of some of the acquisitions that we've seen to close out the year, whether it's Nvidia with Grok, whether it's what we saw with Meta and that Singapore-based company having to do with AI, whether it's what we see right now with Nvidia potentially acquiring an Israeli-based tech company? I mean, they're using their free cash flow to do something. What's the signal for how much this is a shift in narrative going into 2026?
Well, yeah, I mean, I think it does remind me of a little bit of 1998, 1999, 2000, when telecom and tech were converging and frantically, there was frantic deal activity and frantic CapEx activity as well there. And of course, there were some ultimately great winners, and there was a lot of write-offs as well. I don't think, like we talk about FOMO in the stock market, and I think there's FOMO in the C-suite here too, which is that all these giant companies are frantically trying to position themselves for the long haul here. And in that process, you're going to see a lot of narrative rewrites going on, and a lot of people speculating as to who the winners and losers ultimately are. I go back to 3 years ago when Google had that all hands on deck meeting because they were frantically behind in AI, and OpenAI was going to clean their clock, and here we are, and that narrative seems to have just twisted on its head here. I still think it's still so early in this game that it's very hard to declare where the ultimate winners are going to be. I mean, I think that, I talked to a lot of tech executives there that are on the front lines of AI, and they are just sort of bewildered by how this stuff is going to shake out themselves, and they're in this market every day.
Well, to me, this really goes to the question of how do you broaden out, right? What does it mean to diversify? Everyone who's come on this show to end the year has said that diversification is the key for next year. We've seen that in the precious metals trade, although it's arguable that that's not exactly diversification, particularly like when it comes to silver. How much do you see equal weight as being true diversification in this type of backdrop?
Well, really since last January, I started pushing this narrative that, as much as I love the big tech story as a core part of the portfolio, if you want to rotate and diversify, not to go into U.S. cyclicals and values. Now, obviously, there's a lot of specific sectors and specific stocks that have done incredibly well this year in the United States. But thematically, at the index level, what I'd advocated for was a rotation into European equities, which were sort of the ugly ducklings for so long, and in some respects they still are. But I think where I am right now is that, look, we've got the SX5E, I call it the SPX for the European continent. That has outperformed most every U.S. index in local terms, almost caught up with the Mag 7 index. And on a currency adjusted basis, it's blown away most every U.S. major equity index. So looking forward into 2026, where I'm at right now is I think that's going to happen. It's a very different set of dynamics. So I think, look, if the Germans really are going to start committing to this stimulus, and I think that's happening, it's hard to tell. But that is sort of a massive and a very different type of force than, say, the AI force, right? When you're talking about this pretty significant economy really pushing stimulus to a place that it's never been. They have the fiscal space to do it, unlike many other sovereign nations in the developed world.
Right.
And that will be really resonate there. Meanwhile, I think for the U.S. cyclical value trade, well, there's still a lot of, I think, sentiment tied to that. So if you are concerned about the tech I don't want to use the word bubble, but the tech theme, the dominance of tech theme. If you're sort of worried about that kind of not really working next year, to me, I think I sort of see Europe as a pretty good place, with a caveat that the rally this year has been driven largely by PE expansion, and the relative to PEs from Europe to, say, their U.S. counterparts are in a less compelling place than they were 12 months ago.
Yeah, and we have seen that outperformance, particularly on a dollar-adjusted basis so far this year. Just taking a step back, heading into next year, you talk about the fiscal space. And one theme for 2025 has been yield curve steepening. Bespoke Investment Group put out a chart showing that on the Bloomberg Global Aggregate Index, you saw the biggest yield curve steepening going back to the steepest levels since 2016. How much do you expect this to continue and for bonds to fail to provide that haven, particularly on the long end?
Hello? Sorry, Lisa, you cut out for a second. I think I froze up.
Michael, I'm so sorry. Let's leave it there. I think we're having some technical difficulties. Michael, wonderful to hear your thoughts, and I'm sorry to leave it on that note. Michael Purvis of Talbach Capital Advisors, Happy New Year to you, and hopefully we'll see you soon. Right now, let's get you an update on stories elsewhere this morning. Let's head over to London, your Bloomberg Brief with our very own Lizzie Burton. Lizzie.
Hi, Lisa. Warner Brothers Discovery is planning to reject a takeover bid from Paramount after the company amended its terms for its offer. Sources telling us here at Bloomberg that Warner Brothers board will meet next week to make a final decision. The board's concerned that Paramount has yet to increase its offer, which was earlier rejected as inferior to the one from Netflix. Elsewhere, money manager Michael Burry, made famous, of course, by The Big Short, denying being short Tesla shares, despite calling the company ridiculously overvalued earlier this month. Burry's comments come after Tesla took the unusual step of publishing a series of sales estimates indicating the outlook for its vehicle deliveries may be lower than many investors were expecting. And you were just discussing the metals. Well, gold and silver are slipping in this final trading day of 2025, though both remain on track for the record annual performances. The past few weeks have marked a tumultuous end to a historic year for precious metals, and these wild reversals prompted the CME to raise margin requirements on precious metal futures for the second time in less than a week. And that's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. And it raises a question about the banking sector as well as the shadow banking sector, and we'll get into that later in the show. Up next, American healthcare.
These Obamacare subsidies are expiring now. More than 20 million Americans are now bracing for their premiums to skyrocket.
Yeah, they will skyrocket because it was never any good. It's a bad thing. We can have a great thing. Let the money go directly to the people and let them buy their own health care.
George Pollack of Signal Global joins us as we look at ACA subsidies expiring at the end of today. From New York, this is Bloomberg Surveillance. Well, perhaps we didn't get a Santa Claus rally, but we got the rally that everybody wanted and maybe didn't expect this year. The third straight year of double-digit gains, really seeing the track record that we saw back pre-pandemic and the immediate aftermath of it. Right now, you're seeing a little bit of edge come off that froth. What we are seeing is the NASDAQ leading stocks lower, futures lower by about 1/3%. This is the fourth straight day, potentially, of losses as people lack a catalyst to really do anything. Very thin trading. What we have noticed in the bond space, yield curve steepening, and this is a global phenomenon. Take a look at two-year yields, 3.45%. They started the year at 4.23%. They have come down more than 80 basis points. 10-year yields, 4.11. They started the year at 4.55. We haven't seen those kinds of levels in quite a while. The 30-year yield is actually higher than where it was to start the year at 4.77%, and it is another basis point higher today. The yield curve steepening has been the main theme for bond markets around the world and raises a question about how much this has to do with fiscal prowess, the idea of how much government debt there is, as well as potential inflation. When it comes to the fiscal backdrop, under surveillance this morning, American healthcare.
These Obamacare subsidies are expiring now. More than 20 million Americans are now bracing for their premiums to skyrocket.
Yeah, they will skyrocket because it was never any good. I'd like to see the money that is going to the insurance companies by the hundreds of billions of dollars. Their stocks are up through the roof over a fairly short period of time because they're getting vast amounts of money. I want that money to go to the people directly and let the people buy their own health care. And they'll get much better health care than they get with the Unaffordable Care Act. It's a bad thing. We can have a great thing. Let the money go directly to the people and let them buy their own health care.
Here's the latest. Enhanced Affordable Care Act subsidies are set to expire tonight, sending premiums skyrocketing and impacting coverage for millions of Americans. Congress failing to find a resolution before the deadline. Bloomberg's Tyler Kendall joins us now. Tyler, can you give us a sense of what's going to happen at midnight tonight? What has been the discussion in Washington, D.C., and what steps might possibly come early in 2026?
Hey, Lisa, good morning. Well, this is going to have potentially huge impacts for millions of Americans when it comes to higher prices, but then also potentially losing coverage. Data cited by Bloomberg News estimates that out-of-pocket premiums are going to more than double for those on Obamacare. Now, as you mentioned, we're talking about the enhanced subsidies. These were the tax credits that were expanded under a pandemic-era law. So starting tomorrow, those tax credit levels are going to snap back to pre-pandemic levels for lower and middle-income households, but then they're going to go away completely for households earning more than 4 times the federal poverty line. Now, as you mentioned, Congress failed to act, but there are a few ideas on the table. But just keep in mind here, lawmakers aren't back in Washington until January 5th. One is we are going to get a vote on a so-called clean 3-year extension. The Congressional Budget Office estimates that this will add $83 billion to the deficit. That is at least one of the reasons why Republicans remain divided over whether or not they will support any type of extension, though they are pretty aligned that if there is an extension, there has to be structural changes such as an income cap or anti-fraud protections. That's why we're keeping our eyes on this effort that's brewing in the other chamber in the Senate, a bipartisan plan that would include some of those structural changes and then pair it with perhaps a shorter term extension, like 1 or 2 years, essentially to buy lawmakers time so that they can come up with a broader health care plan down the road. Now, Lisa, it's important for us to mention that these ACA premium subsidies, these are refundable tax credits that are calculated on an annual basis. That's why even though we're already past the deadline, you could still see an extension be retroactive. Rather, when I talk to people on the Hill, they're less concerned about getting this money ultimately back into consumers' pockets and more concerned about those consumers that may not enroll if they wake up and see sticker shock and say they don't want one of these plans.
Just quickly here, Tyler, there is this question of another deadline that's coming in January that could potentially lead to another government shutdown. How much discussion is there of another shutdown on Capitol Hill?
So this is something that it could go either way. I have to say a lot of the people that we actually are talking to here in Washington think that we're going to avoid it because Congress has actually done a lot of the legwork already to accomplish their actual job, which is appropriating the spending for the year. We could see another holdup, of course, related to this healthcare battle that is going on. As we know that Democrats are really trying to hold Republicans' feet to the fire. In fact, we've already started to see campaign ads for the midterm starting now that has to do with potentially these rising healthcare costs. But Lisa, as of now, we'll see what happens when they come back in January. But the odds are actually towards that we may avoid that shutdown at the end.
That will be a note of relief, at least for the airline industry, as well as all the other federal workers out there. Tyler Kendall, thank you so much, and we'll see you later in the show. Joining us now is George Pollack of Signum Global. Can you just give us a sense, and great to see you, George, stepping back, how much of a focus this is for Republicans to keep some sort of healthcare solution, how much it is a popular thing for them to do heading into the midterm elections?
Well, the biggest issue for Republicans is healthcare is the one issue where Democrats poll better than Republicans. This is the issue where Democrats can really go on offense and say, we have the better ideas, or at least the more popular ideas. And going into a midterm election, that's already going to be a challenge when they've had the trifecta in D.C., allowing these subsidies to expire and exposing people to doubling of healthcare premiums is just not sustainable, especially if they want to keep the House.
We were talking at the end of last year, or the beginning of this year, about cutting the budget deficit and about cutting expenses. DOGE was a big effort. Now there is a question of how much of those cuts are going to basically come back onto the balance sheet, whether it's IEEPA or whether it's some of these subsidies that get passed over. I'm just wondering, from your perspective, how much of a focus cutting the budget deficit still is in Washington, D.C.?
Look, I think it's a great line. I think when you're the party out of power, it's something you discuss, and you've seen moderate Democrats talk about it, and you've seen most Republicans talk about it. But the reality is, when they passed a one big beautiful bill, yes, that made tax cuts and the tax system permanent and gave businesses and Americans a idea of permanence, but it also cost billions, and it cost a significant amount of money and added to the deficit. It's a great campaign line, but unless there's no real appetite for embracing entitlement reform or anything like that, because it really is the third rail of U.S. politics.
How do you see 2026 being different politically than 2025, given the fact that the midterm elections are coming up and what happened in the midterm elections that we just saw?
I think what you're really going to see is these moderate Republicans who voted for things like the one big beautiful bill, who have defended the president, who are facing a very tough reelect, and with Democrats getting some pretty strong recruits in moderate districts, they're going to really try to separate themselves from the administration, and they're going to really try to stake out themselves as independent or focus-oriented members of Congress who just want to do what's best for America. And I think with Speaker Johnson having a very narrow majority, that's going to be something that he struggles to navigate, especially if he wants to do a second reconciliation bill.
George, there's something that not a lot of people are talking about, but is coming up increasingly on talk shows as well as just in op-ed pages across the country, across the world, how much of a focus there's going to be on artificial intelligence and either regulating it or providing some sort of safety net should there be some sort of mass job loss in the wake of a real adoption that does mean that certain humans are not needed anymore. How much of a discussion is there in Washington, D.C. about this as we head into 2026?
I think what you're going to see is the administration has fully embraced AI as the next great thing for the U.S. economy. And what you're going to see is the likes of both Republicans, so like Governor Ron DeSantis or Governor Spencer Cox, and you're going to see Democrats as well campaign against the administration's whole hog embrace. You've already seen Senator Bernie Sanders talk about suspending data center construction. I think what I put it a parallel to is when they were negotiating the original NAFTA and that trade disruption and the job disruption. I think Democrats are going to say, you're disrupting American jobs. You're threatening social stability, and you're increasing costs in things like energy. And they're going to use it as a huge attack line for the president, especially because Americans are pretty divided. I think there was a recent poll out that only by 5% are they really positive about AI. And that's really people who haven't yet learned all the details. And I think as Democrats hit the administration and the likes of David Sachs, I think that's going to be a very potent issue for Democrats in particular in 2026.
You mentioned Senator Bernie Sanders of Vermont. He is going to be at the inauguration of Zohran Mamdani, I believe, tonight, along with AOC, along with a host of other progressive Democrats. I just wonder what this really signifies for the Democratic Party in 2026. Not necessarily Zohran Mamdani's inauguration, but just is this going to be the mainstream of the Democratic Party heading into the next presidential election season?
Look, I think that's a fantastic question. If you're a tri-state Democrat like Laura Gillen or Tom Suozzi, you're not happy about this because you're going to have to run against Mamdani and you're going to have to deal with the after effects of Mamdani's policies. But I think in reality, this midterm election is going to be a referendum on the president, a referendum on Republicans. And when the Democratic Party has the likes of Marie Gluesenkamp-Perez in Washington, Jake Angelos in Massachusetts, and formerly Jared Golden in Maine, it's really just going to be, Republicans will try to make it circa Nancy Pelosi 2006, 2008, but it's really not going to fly when Americans are more concerned about increasing health premiums, increasing energy costs, and the potential threat of AI.
George Pollack of Signum Global, thank you so much for being with us. Have a wonderful new year. I'm sure we will catch up with you in 2026. Right now, what we do see in markets is a fourth day of softness as traders essentially stay on the couch. It seems like there's not a lot of motivation to get off of it and take any action. The last economic indicator that we get of 2025 will be coming at 8:30 a.m. Eastern. That will come in the form of jobless claims. Coming up, we'll be wrapping up a volatile year for commodities, including our conversation with Chevron CEO Mike Wirth. We have seen the biggest one-year decline in oil futures going back to 2020. We'll discuss why. Plus, Lizzie Burden with your morning movers. Nike jumping after a big stock purchase by its chief executive. Those shares up almost 2%. From New York, this is Bloomberg Surveillance. Good morning. It looks looks like we're setting up for a fourth day of losses, although meager losses after a blockbuster year for equities, the third in a row. Right now, just taking a little bit of heat out of that, 0.2% decline on the S&P, leaving out that euro-dollar cross around the same place where we've been for quite a while at that 117 mark, 411 on the 10-year with yields lower by about a basis point. Silver, look at that, lower by 5.6%. Yesterday it was higher by 5.8%. The day before it was down by 9%. No wonder that the CME Group is raising its margin requirements for the second time in a week. 3 hours away from the cash open, here are your morning movers with Lizzie Burton. Lizzie.
Hey, Lisa. Well, we're going to kick off with Nike shares this morning. The CEO, Elliott Hill, buying $1 million worth of stock. So following in the footsteps of the Apple CEO, Tim Cook, he bought $3 million worth about a week ago, and those shares up nearly 2% in the pre-market. You talked a lot about metals this morning, so let's take you there next. We're looking at some of the big miners down this morning as the metals slide as well. New Gold here down 1.25%. But just for context, of course, the metals have had a banner year so far, as have these stocks. New Gold up about 255% year to date. So these moves are dropping the ocean. Finally, a good news bit for you if you're on the roads this holiday season. Vanda Pharmaceuticals has had its motion sickness drug approved by the FDA. It's been a long old road with the FDA to get this over the line, but that stock soaring 21.6% as a result in the pre-market. Lisa, back to you.
Just in time for all those long car rides for the holiday. Thank you so much, Lizzie. On our radar this morning, minutes from the December Fed meeting showing officials expect more rate cuts ahead should inflation continue cooling. However, policymakers remain divided on timing, suggesting the central bank may hold steady for some time. Meanwhile, Nvidia is reportedly in advanced talks to buy Israel-based AI startup AI-21 Labs for as much as $3 billion. According to Israeli media, AI-21 has long been up for sale, and talks with Nvidia have advanced significantly in recent weeks. It does seem like all of that cash in the balance sheets of big tech are burning some holes in their pockets, and they're looking to spend it a lot this year. Warner Brothers, meanwhile, is planning to reject a revised takeover bid from Paramount Skydance next week. Sources telling us here at Bloomberg, the board views the offer as inferior to a rival bid for Netflix, from Netflix, citing concerns over the price tag and a lack of debt management. The Ellison family very much in the hot seat. Turning to commodities, a blockbuster year for metals. Oil, however, slipping by the most since 2020. Bloomberg's Will Kennedy joins us now for more. Will, this morning we're seeing some firming up in oil prices. How much can OPEC's latest decision change a surplus that we have seen that has really marked the bulk of the action in 2025?
In the short term, Lisa, probably not much. The expectation is that OPEC will stand pat at this meeting and stay at current supply levels. As we look into 2026, many analysts see the potential for further declines from here down through the 50s to perhaps the bottom of the sort of $50 range. And when that happens, I think many people expect that OPEC will have to react in some way and start the work of withdrawing some of this surplus we see from the market and running down what look like pretty ample global inventories.
How much do we see at this point, just some sort of deficit building, not necessarily this year or next year, but it's 2027 or 2028, as certain producers ratchet back their production in response to this glut?
It's the old adage, Lisa, that the best cure for an oversupply is oversupply, that eventually it will do its work, that prices will reach a level where discipline will be forced on the market, that producers won't be able to drill profitably and they'll have to cut back on investment. There are people who think that this glut will, in time, in a couple of years, as you say, actually lead to the potential for a medium-term bull market for oil because the investment won't be there and demand continues to rise. It's been very resilient since the end of the pandemic. It's probably exceeded most people's expectations. The energy transition is not going as fast as many people expected. EVs, as we've seen in the latter part of this year, that story is a little troubled right now, and that most people expect if the global economy continues to grow, oil demand will grow healthily, and that will in time erode the surplus combined with the discipline of low prices that we're seeing this year and we're likely to see at least in the first half of next year.
Well, there has been a huge source of demand coming from China over the past couple of decades. How much has that shifted in terms of China's reliance on fossil fuels shifting to their nuclear power plants, their electric vehicle supplies, some of their lithium production, the fact that they have adopted more renewable sources to shift away from oil?
Yeah, you're quite right to say that, I did paint a picture of the energy transition not going quite as fast as people expected, but it has been extremely rapid and extremely deep in China. China has embraced electric cars like few other nations have. I was in Shanghai in the early part of the year, and it's remarkable to see the number of EVs on the road in that city. And we have seen that come through in much, much slower oil demand growth in China. Gasoline demand has almost certainly peaked in China. We are now starting to see liquefied natural gas make inroads into diesel demand too. So that is definitely part of the picture. But at the same time, the Chinese economy continues to grow. Its energy demand continues to grow, and it grows on a very broad base. Yes, there are lots of renewables, but it's worth mentioning that oil demand in the broad terms continues to tick higher. Gas demand is ticking higher. Coal demand has yet to peak in the Chinese economy. So it remains a very energy-hungry economy. And so you're not going to lose huge amounts of oil demand from China, perhaps. And we have other economies coming to fill the gap. India, of course, but other emerging economies in Asia, in Africa, in Latin America.
Will Kennedy, thank you so much for being with us. As always, have a wonderful new year. Meanwhile, crude is not there yet. It's on track for its deepest annual loss since the pandemic. Producers weighing geopolitical tensions against concerns about that global glut we were just speaking with. Earlier this month, Annmarie and myself caught up with Chevron CEO Mike Wirth and discussed his outlook for 2026 and beyond.
We make our investment plans on a long-term basis. We look at supply and demand well out into the future. And so the price of oil today can affect short-term financial performance of the company, but it really doesn't play as much into some of the longer-term investment plans as we look down the road, not really out the window, as we decide what the capital program looks like.
But how do you reconcile the two? Because you're doing a lot of exploration internationally. And to Lisa's point, prices are low and potentially are going to even go lower.
Well, exploration is a long cycle business. We just brought a project online in the Gulf of America last year where the discovery was made 20 years prior. And so the timeline between when you actually make a discovery, when you appraise that, and you ultimately develop it and bring it to market can be years or even decades. And so we really have to take that long view on the business. And, in the short term, we'll keep costs tight. We've guided to, industry-leading free cash flow over the next few years as we bring costs down, capital spending down, increase the synergies on the Hess transaction. So we're going to deliver strong financial performance through the cycle.
Based on what the IEA has said, recalibrated where they see oil demand growing, it was 2030, now it's 2050. OPEC says they had a rendezvous with reality, seeing that the world needs a lot more of this, a lot more fossil fuels. If outlook is so strong, should Chevron, should all of these big oil companies, should they increasing more of that investment?
Well, on the IEA, even a broken clock is right twice a day. So they have finally acknowledged what we've long known, which is that the world will continue using oil and gas for many decades into the future. We are in that long cycle business, and the capital spending, Annmarie, has become more efficient in our industry. A decade ago, we were spending money on big projects. There was a lot of growth going on in shale at a relatively high cost structure, and the entire industry has found ways to standardize designs, simplify projects, and actually get more for every capital dollar that we spend. So the size of our capital spending doesn't necessarily correlate to the growth the way that it would have in years gone by.
You've been talking about the capital profile and investments and how it's become a lot more efficient to make the same kinds of investments and frankly, the same kind of output. Where is this efficiency coming from? Is it coming from artificial intelligence? Is it coming from just better technology and getting oil and gas out of the ground?
Yeah, so in shale, for instance, which is something the U.S. has been a world leader in, A decade ago, break-evens were $70 or $80 a barrel. Today, they're not even half of that, as we found ways to drill longer laterals, to optimize the spacing of wells, to complete wells at lower cost with greater production coming out of them. So it's a series of things. In the deep water, we've simplified and standardized designs. And what used to take $30 a barrel or more in terms of cost of capital to go into a project now has been cut in half. And so it's not driven by AI yet. I do think over time we're going to see technologies like that continue this path that we're on.
We're going to get to that in just a second. If that's the case, if you can get more, even at a break-even cost that's a lot lower, why has the rig count gone down so much? Why aren't there more rigs coming online, given the capacity here in the United States?
Because we can drill more feet per day with a rig today than we could in the past. And so rig count is not nearly as interesting a metric as how many feet a day you can drill, how many wells you can complete in a period of time. And so we're getting more work done out of fewer pieces of equipment today.
You talk about how AI isn't delivering those efficiencies yet, the indication being that maybe down the road it might be the case. Where specifically are you thinking? And I'm saying at a time when Chevron's cutting staff, so are other people. Is this a headcount issue? Is this something else? How are you seeing it being deployed?
Well, I think we're still in the very early days of applying AI at scale in our industry. One of the things that's undeniable about AI is it needs lots of data. A company like ours has as much data as just about any company in the world. And so we've got decades and decades of geologic data, seismic data, operating data, all of which can be used to feed these models to optimize operations, to improve our exploration success, to squeeze more production out of existing assets. And so we see huge opportunities to run our business with smarter technology, get better decisions made faster. And so there's certainly a cost dimension to this, but I think the real opportunity is going to be about the productivity of our assets and our business.
You announced this project, the first of its kind, to provide natural gas-fired power for data centers. Do you expect to do more of these projects? And what's the update on this one in West Texas?
Well, certainly the demand for power has been talked about now for the last year or so as the constraint in the growth of AI. Data centers and the ambition for data centers at a scale we've never seen before has become a commonplace. The reality is we need large-scale power. What we're working on is off-the-grid power, because it's also becoming an issue with electricity prices, and we're seeing this show up in consumer sentiment, in elections. Our approach is to develop gigawatt-scale power generation, not through the grid, but dedicated to data centers. We've got a project in a couple of sites, actually, we're working on in West Texas, where we've got a lot of natural gas. We've got large gas turbines, the largest in the world, being delivered starting next year. And we're deep into discussions with multiple customers that would like to site data centers to use this power.
You're at the center of a lot of politically very important conversations, not just when it comes to AI, not just when it comes to Lukoil assets, also Venezuela, the only American company left. Can you give us an update on either conversations with the administration, your team on the ground? What is the future of Chevron in this country as the president says maybe he's going to send troops there?
Yeah, I don't know what the president's intentions are. We've been in Venezuela for the last 100 years. Our presence there, we believe, is important for the local economy, the regional economy, the people of Venezuela. The Venezuelan oil is sought after by U.S. refiners, and we operate there in full compliance with all U.S. law and sanctions. We're in discussions with the administration to ensure that we stay in compliance, that they understand the value that our presence brings to America. And so, that's...
And you plan on being there for the long term?
Venezuela actually has more oil and gas resource than Saudi Arabia. It's right here in our hemisphere, very close to the Gulf Coast refining complex. And we've been there through ups and downs. And like many places in the world, we have to take a long view on our presence in countries like this.
That was our conversation with Chevron CEO Mike Wirth earlier this month. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
Hi, Lisa. Tatiana Schlossberg, granddaughter of former President John F. Kennedy, has died at the age of 35. she had disclosed and detailed her battle with acute myeloid leukemia, a cancer of the blood and bone marrow. Schlossberg was an enterprising journalist who wrote for the Metro and Science desks of the New York Times before transitioning into freelance writing. Elsewhere, Elon Musk's xAI has purchased a third building in Memphis to expand its data center complex. The billionaire wrote on X that'll bring the company's AI computing capacity to almost 2 gigawatts. Musk has publicly discussed the plans to build the world's largest data center for AI training and posted earlier this year that Colossus 2 will eventually have 550,000 chips from Nvidia. And revelers wanting to celebrate the new year in New York's Times Square will need to wrap up. New York City temperatures are projected to drop as low as 26 degrees Fahrenheit, with a chance of snow later in the night. Meanwhile, on the West Coast, there's a rising risk of flash floods in Los Angeles, and there's a near 100% chance of a wet New Year's Day rose parade. But a 100% chance of fun. That's Bloomberg Brief, Lisa.
Thank you so much, Lizzie. Up next, investors are waiting one more read on the labor market. Michael Reed of RBC joins next. This is Bloomberg Surveillance. A fourth day of softness after a real blockbuster year for equities. Right now, taking some edge off that, down about 0.2% on S&P futures. The euro-dollar cross has been around that 117 level for quite a while, and 10-year yields lower by about a basis point to just a little under 4.11%. Silver we're keeping track of just because it's been so volatile, down 9%, up 5.5%, down 5.5%. This is the reason why you have the likes of the CME Group coming out and limiting some of their margin, or asking for more margin for some of the trades. Under surveillance this morning, the state of the labor market. Investors are waiting the last read on employment in 2025. Jobless claims due at 8:30 a.m. Eastern for the holiday-shortened week. Michael Reed of RBC Capital Markets writing, we maintain our view that tariffs will weigh on the labor market and put upward pressure on inflation, reinforcing that the U.S. economy is experiencing stagflation light. Michael joins us now in the flesh in New York. Thank you so much for being here on this New Year's Eve. I'm just wondering, from your perspective, stagflation light, what does that mean, and why do you see that taking hold in 2026?
Sure, and thanks for having me. So what we are expecting is generally below trend growth. That means below 2%, and inflation that remains uncomfortably high, really in that core space. So when you think about some of the dynamics, and it's not just tariffs, I should add, we just think it's going to be really hard to get back to 2%, even if you take tariffs off the table.
Does it seem like Fed officials really care? I mean, based on the meeting minutes, there was a priority on the labor market, not necessarily inflation.
I think they do care. And what's really interesting is if you look at what they've said, especially in the last meeting, you include the fact that they view tariffs as being transitory, yet they're starting to take that cautious approach. They think they've gotten to a place that is much more closer to neutral. So they're concerned about the inflationary pressure, not just from tariffs, but coming from other places. And we think that's showing up in the services space in particular as it relates to labor supply.
So where exactly are you seeing this inflationary pressure? I can hear Neil Dutta in my head saying, look at housing. You're not seeing any inflationary pressure there. In fact, the housing data yesterday, we did get some signs that maybe it's picking up, but otherwise you've seen pretty much flat home prices across the country. I mean, at what point do you see some sort of inflationary pressure that could be sticky?
We see it in the wage space. And, when you think about some of the dynamics that we're seeing in terms of supply, we have immigration that's falling. We have retirements that we think continue to accelerate. At the same time, your demand for labor, while slowing, still hanging in there. So what that means is you're going to have a situation where the need for workers is still there. It's just showing up as replacement demand. So payrolls aren't going to look great by any means, but we are going to expect an environment where the unemployment rate remains low, and we think it plateaus around 4.5% for most of this year. And that just means you're going to have an environment where wage pressures stay elevated.
Yeah, well, so this is definitely the truth when it comes to healthcare. We've seen the bulk of hiring so far this year in healthcare. We're getting older. We still need to be taken care of. This does, though, raise a question about other sectors and what that means about the strength of the labor market. I mean, how durable is some of the strength that we've seen if it is concentrated in a completely recession-proof area like healthcare?
I mean, healthcare is a big one. So again, going back to this demographic story, you think about the sheer size of the population that's now over 65. You have about just under 40 million people in the workforce right now who are 55 plus. So they're approaching that retirement age. That's who we're really focused on. Those are the folks who are going to continue to use healthcare services across the board. So that's a sector that we expect both will continue to hire at a very healthy clip. 50 to 60,000 jobs per month over the next 5 years seems very reasonable to us. And in addition, you do have that price pressure. So when you think about some of the factors impacting prices in terms of tariffs, but as well as supply chains, that's going to continue to put upward pressure on services. So for healthcare, which is a very service-intensive type of sector, there's very little relief that we expect to see there.
There's a theory that the Fed is trying to run the economy hot to keep people employed as we get this structural shift with artificial intelligence, that as people become less necessary, you want to keep as many people as possible employed before we get to whatever that next future is. How much credence do you see in that? Do you think that that is wise for them to take that approach, given some of the cannibalization from human jobs?
I mean, look, their dual mandate is low prices and stable employment. So I think that aligns to what they're trying to do in terms of the mandate. Now, the outcomes for AI are still very early. Could we see a productivity boost? Absolutely. We expect that. Do we expect to see it in 2026? Not so much. But when you think about some of the dynamics that are going on right now over the next 4 to 5 years, when you account for that retirement boom that we continue to see, and the slowdown in immigration, you're going to need more workers. And if you don't have it coming from the outside, that immigration story, AI is going to have a very important role to play there to help supplement the falling labor supply. So that could help offset some of those inflationary pressures coming in the wage space.
Just in a shorter term time phrase, so we are going to get some real data in January that people think will be some cleaner data points to look at when the Fed meets on January 28th. What are you expecting when it comes to both CPI and, of course, the jobs report for the month of December?
So we're going to get a lot of mixed signals here, again, even in December, Q1. For the jobs report, like the Fed, we expect that the number will be, look okay at face value, but you have to subtract out the benchmark revisions that are going to come from QCW. So already you have to take out 50 to 70,000 jobs per month based on that revision. So that's a big part of, I think, how the Fed is thinking about this, especially as it relates to that break-even pace of employment. That's why we've seen that unemployment rate rise despite rather healthy job gains from the payroll report. In terms of CPI, for December, we think we continue to see kind of a modest slowdown in terms of the pace, but it's really Q1 that's our concern. We've seen these seasonal quirks, notably in January, and we think that could be more pronounced as tariff pressure starts to add up in the start of 2026.
Michael Reed of RBC, thank you so much for being with us. Coming up next, Bloomberg's Matt Miller does enter the building. He joins me alongside Barbara Duran of BD8 Capital, Bloomberg's Matthew Griffin, and Chris McGrady of KBW. This is Bloomberg.
You kind of see shades of this K-shaped economy, K-shaped market.
Instead of any sort of dramatic surge that could reignite inflation pressures, we will see hiring activity slowly start to pick up.
If employment keeps weakening, if inflation kind of stays somewhat cool, it's hard to imagine that the Fed doesn't cut more.
What matters is how the interplay of the risks and the tailwinds are going to interplay in 2026.
2026 is really about adaptability.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks poised for a fourth straight day of losses, with traders lacking a reason to shift around their equity holdings after a blockbuster year in the stock space. But some big moves out there today, particularly in precious metals, with escalating volatility prompting CME Group to hike margins for the second time in a week and getting the final economic release of 2025 with jobless claims on deck as Fed officials signal 2 more rate cuts to come in 2026. Matt Miller, I am so pleased to say, has graced us with his presence and will be joining us for the next 2 hours in a very snazzy sport coat. Is this like a New Year's Eve thing? Is this a Christmas thing?
No, it could be either one, right? But I figured for New Year's Eve, it doesn't have to be dark blue or black. And why not? You know, we've had a banner year. We're up, 90% in 3 years? We haven't had a run like this since the dot-com boom. So let's celebrate.
Yeah, and if we get another double-digit return for next year, just wait to see what Matt wears then. There is this question about looking back and what we've seen so far this year and what it means for the path ahead. I'm thinking of the dollar in particular weakening at the fastest pace going back to 2017. A question of whether this will continue, Matt, and what this means given the outperformance that we've seen in gold and silver, which have delivered their best annual performance so far going back to 1979.
Yeah, the outperformance of gold and silver has been remarkable, even with the slight drops that we're seeing today. There's still eye-popping year-to-date gains. The dollar's weakness, 2017 wasn't really that long ago, and I thought, and a lot of people told me on my show, Bloomberg Open Interest, that it would be a lot worse at the beginning of this year. So I think we're doing pretty well to cap it at only an 8 or 9% loss for the year.
The big question for next year, is this just the beginning, or is this the extent of any kind of declines that we're seeing in the dollar? And what does the decline of the dollar versus those precious metals mean going forward? Right now in markets, we're not seeing a lot of action, although, again, as Matt was saying, we've seen a 90% gain in 3 years, and he is wearing a very important suit jacket to represent that. Right now, taking some froth out of that, 0.2% decline on S&P futures. Yields lower by about 2 basis points on the 10-year to 4.1%. Crude getting a bit of a bid after the worst year for the fossil fuel going back to the height of the pandemic. Coming up this hour, Barbara Duran of BD8 as the Fed minutes reveal deep divisions with the FOMC. Bloomberg's Matthew Griffin as the AI trade shifts to pick and shovel stocks. And Chris McGratty of KBW with U.S. banks on track for a strong 2026. We begin this hour with stocks struggling to find momentum as rifts within the Federal Reserve raise questions over future cuts. Bloomberg's Tyler Kendall joins us now from Washington, D.C. Tyler, great to have you back. A real question here about what we learned from the meeting minutes. You were tracking them all.
Yeah. Hey, Lisa. Good morning. Well, most participants saw the need for future cuts as inflation declines over time, but they remain divided on when and how much to cut. The minutes really put a finer point on the fact that this is a divided FOMC and the considerable differences as policymakers weigh the risks between inflation and employment. And we got insight into just how close this December meeting was with some of the participants who voted in favor of the cut, saying that their decision was, quote, finely balanced, and that actually they could have voted instead to keep the target range unchanged. The minutes really did read like this back and forth conversation with at one point some participants pointing to the risk that higher inflation could become entrenched. Now, looking ahead, this was the key line that we pulled out. It said that some participants did say it, quote, likely is appropriate to keep the target range unchanged for some time. As of this morning, investors in Fed funds futures were assigning a 17% chance that we could see a cut in January. And Lisa, as you were mentioning at the end of last hour, there is a lot to keep our eye on as we head into January and the new year. You mentioned CPI, also the employment report out on January 9th. But of course, what is looming over all of this, which is that we are expecting President Trump to announce his pick to lead the Federal Reserve, as he himself says that he already has a favorite.
Bloomberg's Tyler Kendall, thank you so much. And I just learned that Matt Miller is also wearing a kilt because he is celebrating Hogmanay, which is the Scottish New Year. That is what we learned from Lizzie Burden over in London. Thank you for that. I'm glad to see that.
It's not true. It's not true.
You're not
I
wearing
wish.
a kilt?
I wish.
Okay, well, maybe next year, if they get another double-digit return, Matthew Miller will show up in a kilt. Barbara Duran is not wearing a kilt. Of BD8 Capital, she wrote, the Fed could be stingy on rate cuts unless labor takes a big dive. Barbara joins us now for more. Barbara, thank you so much for being here. Really appreciate it. On this New Year's Eve, a real question about the Fed and how much they can cut, given the dual mandate that they have of a labor market that they seem to be prioritizing right now.
Yeah, they definitely are. Yeah, because the labor numbers have been soft. You saw that in the ADP number a few weeks ago, and of course, jobs. But what we're not seeing is any really follow through on jobless claims. They are still not signaling, any danger there, and that obviously is a leading indicator. But I think that's where the emphasis is, because inflation seems to have stabilized. I think somewhere around here, 2.9. I think it could creep up a little bit higher, because even though the tariff impact has not been as severe as everybody expected, including myself, it's still feeding through now that there seems to be some stability in the outlook, for tariffs. So I think you could see it inch a little higher, but you're certainly not going to see it as it happened at post-COVID and things were opening up. So I think they are right to focus on labor and what that means. And right now we know what's happening in terms of lower immigration, baby boomers retiring. And so, but it looks in balance. So you could see lower job creation, but that's because the demand will be lower. So, but that's the key thing. And the economic data has been a little bit behind. And we know there's problems with the recent CPI number. So I think it continues. The Fed is still going to be data dependent. But I don't see them cutting in the next month or so, because they need to see really if the trend in labor is going to continue to gradually go down or if it's going to be much stronger.
What do you expect there? Because we've had incredible growth, right? 4% essentially in Q3. We're expecting, above trend growth in Q4 as well, or at least at 3%. Right. And it's not like the labor pool is getting any bigger. We don't have any immigration to speak of. Demographics are going the wrong way. So do you expect unemployment to rise in 2026?
It could go up a tad more, but no, I don't see why it would go up. People are still spending, and obviously we know that's a major driver, 3/4 of the economy. And certainly some of the expectations for holiday spending is 4 to 5%. And some of the recent data, consumers are spending. And I think a big part of that is still this 40 to 50 trillion in wealth, trillion in wealth that's been created since 2019. That's out there. And people are still employed. Wages are not going up as fast, but they're still there. And that 4.3%, which we know was a percentage point higher for the third quarter GDP, is really interesting, because that means the 1.9% that the Fed is estimating for next year could be low. And that obviously is a question then, where do you invest? And that could be more cyclical rotation. In financial should continue to be strong. Certain industrials really tied to data center build out and on reshoring, all that sort of thing. So that GDP number is very interesting. And I think that strength could continue.
Well, and earnings continue to look strong as well. I mean, forecasts are for double-digit earnings gains again in 2026. Do we finally get the broadening out? Is it, a substantial broadening out of the rest of the S&P rather than just these mega cap tech stocks?
Yeah, and I think that's the question of the moment. I think part of what we're seeing, why it's been soft this last few days, we had the market making new highs. So the classic Santa rally, which is the last 5 days, doesn't seem to be happening. But I think that's because, there's a lot of tax loss selling, people trying to figure out where to rotate into, because I think the strength will be higher. And the estimates for next year are 12 to 15% in earnings, doing bottoms up, measuring. And so that bodes very well. And we've been seeing this quarterly increase. So what I think it does mean is this broadening out. I think you continue to have the so-called Mag 7 be strong. And you've seen only 2 have outperformed this year, but you'll continue to see profit taking and then moments where they continue, and they will move higher. These are, compounders. You look at Nvidia, for instance, 26 times next year's earnings, and those earnings will continue to come up. So I think you stay in the Mag 7. That's going to be core, and obviously given the percentage of their, it's 30% of the market cap of the S&P, 40+% of profits. You stay there, but you should see financials, industrials. I don't think small cap continues to perform. I think that was a trade, and part of that's because interest rates, right now I see maybe one more cut. The Fed signaling 2, but I don't see it. It's going to be very dependent.
So we were speaking earlier with Michael Purvis about some of the transactions that we've seen to end the year, whether it's Nvidia going after Grok, whether it's Nvidia's transaction with an Israeli AI company this morning, whether it's something that we saw with Meta having to do with a Singapore-based AI company. And he was saying this kind of resembles 1999, 2000, where they're just having this sort of FOMO, and the C-suite try to get as much as they possibly can. It sounds like you see it a little differently. Is that right?
I do. I mean, there is always the potential for overbuilding. Everybody sees the same opportunity. We know this happens in a capitalist society, that always happens. But I think we're far away from the moment. And 2019 is not, I think, a good analogy, because so many of those companies did not have earnings. It was just like, invest in, it was wild. It was a free-for-all. And so here it's very different. I mean, the companies, the hyperscalers, et cetera, they have huge cash flow. And it's only Oracle that is really dipping deep into the debt side of things. The others are, are using their free cash flow. So I think it's very different. So at some point, yes, it will end. But I don't think we have to worry about that this year.
You were talking about diversification and how it's not going to come from small caps, how it's probably not going to come from the other 493 necessarily. Is it going to come from Europe? Is it going to come from overseas? That's what we've seen this year.
Right. I mean, you've seen outperformance in the emerging markets, certain emerging markets. Certainly things seem to be stabilizing with China in terms of the rhetoric between us and them, which is a good thing. You've also had, with the dollar down 10%, the question is, does it continue to go down, or is it stable here? And of course, that is tied to interest rates and how much the Fed will cut or not cut. So I think you probably still have an EEM, the emerging markets, earnings were better, it's more stable. So I think you've got opportunities there. And certainly we know the European defense build out and fiscal spending is not over in 6 months. So you probably do have more upside. So diversification, you can look abroad.
I have a sports question, and maybe Lisa can weigh in too, because she's got kids in this age range. I was having a discussion with people last night who have teenagers that aren't playing football. And I'll get to why in a second.
It's okay. Carry on.
And where I live in Edgemont and Scarsdale, there are years where we can't field a team anymore, just because parents don't want to risk the brain injuries. And I noticed looking at your CV that you're on the Lacrosse Association and the Field Hockey Association. I wonder if those sports are any safer. Are those sports, I mean, I know they're picking up massive amounts of popularity.
Yeah.
Do you think we're going to see the same trend in football happen there, or is it different?
These are always interesting questions. Lacrosse, there's men's and women's that are very different. Women aren't allowed to hit each other. Men can, but they've got a lot of equipment.
Not allowed to, but I imagine they still do.
Yeah. I have a plate in this hand as a result of that. But, it does. And also field hockey, you've got mouth guards, you've got this and that. And there is real awareness and consciousness, certainly in high school, area. But so there's awareness, but I don't think it rises to the level of football, which has such well-documented serious injuries.
So maybe lacrosse and field hockey take market share. I mean,
it would be nice, but I think it's two different things. Being a field hockey.
PDA Capital, indeed. And I will just say thank you so much. Matt, have you seen the new helmets that they have and how kids won't wear them because they look like bobbleheads? And so they're teenagers and they want to look cool, and wearing a big bobblehead on their head, as much as it might protect their brain in 10 years, doesn't work for them. So, I
mean, hopefully they do adopt them. If they really help, hopefully kids get over that and realize that's a sacrifice they have to make to play football. But,
You know what? I'm with you, though. With teenage boys in particular, do I really want them playing football? Yeah. I don't know. Right now, we can have that discussion endlessly, as well as his discussion about his jacket. Let's get you an update right now on stories elsewhere this morning. Here is your Scottish morning with Bloomberg Brief with Lizzie Burden. Lizzie, over to you.
Well, I'm backing seeing Matt Miller in a kilt. 2026 is the year. But let's get to your top stories. Russia and Ukraine striking each other's Black Sea ports overnight, damaging infrastructure, including an oil refinery. Moscow and Kyiv have repeatedly targeted each other's ports in recent months, compounding challenges for shippers of various commodities, from grains all the way to oil. 2 people were hospitalized in Russia and 6 were injured in Ukraine. Elsewhere, Eurostar is resuming service today after a power issue in the Channel Tunnel disrupted operations yesterday. In a statement on its website, Eurostar said, "We plan to run all of our services today. However, due to knock-on impacts, there may still be some delays and possible last-minute cancellations." And if you're hoping to get a Trump mobile phone, you're going to have to wait a little bit longer. According to the Financial Times, the phone company launched by the president's family business won't be available by the end of the year as originally planned. The company telling the FT that shipments of the $499 gold-coloured phone were delayed by the recent government shutdown. And that's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. Up next, expanding the AI trade.
To provide a smoother road for investors along this AI revolution, you need to build a diversified portfolio across the entire ecosystem. We're in batting practice of a doubleheader. Batting practice involves infrastructure.
Bloomberg's Michael Griffin joins us on that coming up next. This is Bloomberg Surveillance. Good morning. Seeing a bit of softness right now into the final trading session of 2025 after 3 straight sessions of declines, taking some of the heat out of a rally that really has been tremendous. The 3rd straight year of double-digit gains. S&P futures lower by 0.2%. Santa Claus rally not necessarily meaning all that much after what we have seen. What was that, 90% gains over the past years?
Yeah, exactly. I mean, what we've seen in 23, 24, and now 25 rivals the 90s. We haven't seen anything like that in this century.
Yeah, and a lot of people are expecting double-digit returns for next year as well, which would bring us back to a late 1990s type of trend. Meanwhile, in the bond space, you've seen yield curves steepening globally. We do see a bit of a bid into yields more broadly this morning, with 10-year yields lower by almost 2 basis points. Similar move in the 30-year, but notable that we started the year around 4.55% on the 10-year. We are now at 4.1%. The 30-year yield has basically remained range-bound in and around 4.8%. Meanwhile, we are looking at big tech at a time when everyone is saying the AI trade has really driven so much of the gains, so much of the productivity, so much of the GDP in the United States. If you take a look, for example, at Nvidia, which has led so much of the gains, they have just skyrocketed this year, up some 40%, but not as much as Google. This is actually interesting. You have seen a shift to some of the use cases of AI, up 66%. Microsoft falling behind at just under 16%. Under surveillance this morning, expanding the AI trade.
To provide a smoother road for investors along this AI revolution, you need to build a diversified portfolio across the entire ecosystem. Don't lean so much into semiconductors and chips and software plays right now. We're still in the infrastructure build-out portion of this revolution. We're in batting practice of a doubleheader. Batting practice involves infrastructure. The games involve the actual spending and deployment of AI. So I would shift more time and attention to the data center plays, data center construction, electrical connectivity, and then bring in the utility plays as well.
Here's the latest. Investors expanding the AI trade beyond big tech with plays in power, construction, and data storage, as you just heard there. Bloomberg's Matthew Griffin joins us now for more. Matthew, thank you so much for being here. Great to see you. So how are you seeing people shift at a time when we already have seen a lot of money go towards some of these picks and shovel trades?
Well, Lisa, thanks so much for having me. It's not so much that investors are exiting the AI trades that they've already made. I mean, Nvidia has had a great year, up about 40%, but it's more that investors are hungry for new ways to play the theme, especially as some of these older trades get a little more crowded. And so that's why you see companies going into names like SanDisk, that's data storage. They're actually the best performer in the S&P 500 this year. Their shares are up 570%, so really nothing to sneeze at there. Companies that build data centers and the infrastructure that data centers use, so Quanta Services, Primoris Services, those are some of the names there. Generac makes backup generators. Even Bitcoin miners actually getting getting some of the loves. Companies like Iron, like BitDeer, they have all this power that they use to mine cryptocurrencies, and now they're deploying it for power and computing for data centers.
Not to be existential, but what are we doing this for? I mean, if you build it, will they come is sort of the existential question here when we really haven't seen the productivity gains yet in the broader ecosystem of U.S. companies.
Yes, this is absolutely one of the risks for investors. So my colleague Carmen Reinecke had a great story about this trend yesterday. And what one money manager told her is, if you want to understand the risks, look at the early days of COVID. You had companies that were selling things, hand sanitizer, personal protective gear. That's great when there's huge demand, but if that dries up, the downturn in demand can be swift. So some of these companies are highly valued. You look at GE Vernova, they're a power equipment company. Their shares have doubled this year. They trade at 50 times forward earnings. Not a lot of room for error. I think the other thing, though, the reason investors are bullish on picks and shovels is you don't have to know exactly what the gold is in the gold rush. You don't have to know exactly who will see the productivity gains, exactly what consumers will end up using in AI. So maybe there is a little more room for error on the fundamentals in that sense.
Yeah, GE Vernova trades at 90 times estimated earnings for next year. So massive valuation there. I wonder about the hyperscalers, which I guess maybe the gold, right? Nvidia, Meta. We've been talking about the free cash flow with Barbara. That's the difference between now and the 90s, right? Because what you don't want is a Cisco. You don't want a company that's spending all this money to lay out fiber and then it's not used properly or profitably for 5 or 6 years. Are these picks and shovels players actually making money? Do they have also the big free cash flow numbers that an Nvidia and a Meta have?
I think there is a comparison to the hyperscalers there, which is that a lot of these companies had businesses before they were ever linked to AI. In fact, pretty much everyone that I named had a business. So, there's a lot of other construction that happens. There are other companies that buy backup generators. There, even the Bitcoin miners, they had streams of revenue from mining Bitcoin. An interesting one that we've actually talked about before is Caterpillar. So Caterpillar makes bulldozers and backhoes, right? Well, they also make power turbines. Those are being used to power data centers. Investors are very bullish about that, but this is a huge company. So even if some of the share gains are coming from AI, there's a lot for these companies to fall back on.
Yeah, Cat actually has $8 billion in free cash flow, and they're only trading at 31 times earnings. So it's really fascinating to see companies like that, even Deere, for example, get linked to the AI trade because they make the sort of earth-moving equipment that Elon Musk needs to build his Colossus, right? Do you see more of that?
Yes, I absolutely think more companies are going to get in on this trend. We actually saw an announcement yesterday. There's a company called FTAI Aviation. They own, maintain, and lease jet aircraft engines. And they said yesterday they're going to be converting some of their engines to run power generators for data centers. Their stock got a nice boost on that. And again, this is not a company that you would think of as an AI player, but investors are looking for new ways to play the theme.
Well, look at Ford last week.
Yeah.
Ford said they're going to shift their car battery making capacity to build, essentially power walls for data centers.
Yeah, absolutely. I think every company that has even a tangential relationship to construction, to electricity right now has to be at least looking at whether there's an AI play there.
Matthew Griffin, thank you so much for being with us. Really interesting, although it does kind of feel reminiscent, Matt, of, remember when Overstock said that it was a blockchain company?
Yes.
And everyone thought, wow, furniture on the blockchain. And then that didn't come to fruition. It feels a little like it could go that route, too.
It feels a lot like 1999, frankly. And until you look at the actual profitability numbers, it really does mirror that time at the end of the dot-com bust.
Yeah, so this will be the year that maybe the proof will be in the pudding, or maybe we'll just keep kicking the can down the road. Coming up, an in-depth conversation with Bridgewater founder Ray Dalio on the top risks for 2026 with AI among them. Plus, Lizzie Burden joins with your morning movers. Shares of Nike jumping following a major stock purchase by its chief executive officer. Those shares up by 2.6% in pre-market trading. Otherwise, pretty soft out there as people find little reason to get off the couch. This is Bloomberg Surveillance. Good morning. Well, you didn't get the Santa Claus rally. That's the bad news. The good news is you got double-digit gains, more than 20% gains on the NASDAQ, 17% gains on the S&P. I guess people wanted even more. Nonetheless, we are seeing a bit of a dip on the fourth straight session to end out 2025. S&P futures lower by 0.1%. NASDAQ down 0.2%. The Russell 2000 down by 0.1% as well. A real question about the rotation trade and how much it hinges on Fed rate cuts next year. If you take a look at 2s, 10s, and 30s for the bulk of this year, you have seen yield curve steepening. You have seen the front end rally hard with 80 basis points of a decline. On the long end, though, you haven't seen any movement at all. 30-year yield still around that 4.8% level. This morning, the reverse. You're seeing a little bit of that curve flattening with less of a rally at the front end and more of a rally at the long end. If you take a look at where the action really has been over the past week or two, it has been in silver and gold. Those shares have been, or those precious metals are lower today. They have had a rip-roaring year, the best year going back to 1979. Silver up some almost 150%. And this comes at a time where the CME group is saying, okay, maybe post more margin because the volatility is getting pretty intense. 2 hours away from the cash open, here are your morning movers with Lizzie Burden. Lizzie.
Hey, Lisa, I want to start with the drama of 2025, and that is the Warner, Paramount and Netflix takeover battle. This is the news that Paramount's bid for Warner is set to be rejected next week. You have had the assurances from Larry Ellison that he's going to guarantee personally the financing on that deal, but Warner's board apparently unmoved by those promises because Paramount hasn't upped its offer. So all three sliding in the pre-market. Next up, we turn over to Nike and the news that the CEO Elliott Hill has bought $1 million worth of stock, following in the footsteps of the Apple CEO Tim Cook. He bought $3 million worth of stock in Nike on Christmas Eve, so those shares up 2.5% in the pre-market. And finally, we turn over to Vanda Pharmaceuticals. They've had a motion sickness drug approved by the FDA. It's been a long road getting this approval. Not quite going to be on the shelves in time for the holiday season, but it should be there in the coming months. So that's up 21% in the pre-market. Lisa, back to you.
Thank you so much, Lizzie. And that makes me feel really good. I always get motion sickness in long car rides. You don't?
No.
Okay, well, at least I will be the one celebrating a motion sickness drug, maybe TMI. Meanwhile, let's shift gears quickly. On our radar this morning, millions of Americans facing higher prices for their health insurance in the new year. As subsidies for the Affordable Care Act expire tonight, Congress failed to extend the expanded tax credits earlier this month. Meanwhile, Reuters reporting Nvidia is approaching Taiwan semiconductor manufacturing to ramp up production of its H200 artificial intelligence chips. This as demand from Chinese tech companies accelerates. Matt, this was a question. If the U.S. allowed Nvidia to sell H200 chips, would China buy them? And it seems like maybe the answer is yes, and in spades.
Yeah, I think it is a really fascinating story because it does look like the Chinese Communist Party has been trying to convince its domestic producers not to buy these chips. They've issued various warnings and regulations over the last year, and yet the demand is clearly still there. The sales are happening as much as they are allowed to by the U.S. It's also fascinating that, we're worried about the national security ramifications of allowing China to have this technology. But I guess if they pay us enough, we don't care.
Right. How much is it a national security issue and how much is it a commercial issue?
Right.
And that's been sort of the debate for a long time this year when it comes to a lot of national security issues and tech. It also speaks to what we saw yesterday with the CCP coming out and saying, we're thinking of maybe preventing you from creating certain AI-related technology unless 50% or more is manufactured in China. There was a caveat there, asterisk. There are certain areas where this could be exempted if companies demand it. How much are the companies pushing back against some of these national security provisions and saying, we need those to step forward?
Yeah, Chinese Jensen Huang's telling President Xi that, look, this is not only important for us in terms of profitability, but in terms of the best interests of this country, right? The idea that China should use our technology has been pushed by Howard Lutnick on this show, right? Because he says if they use our technology, if they get addicted to our technology, we're the ultimate winners there. And I guess they must see it the same way in reverse.
Yeah, a question of tech, belt and road and how much they want to and can implement that. Meanwhile, in the same kind of sphere, Elon Musk's XAI is planning on expansion of its massive data center complex in Memphis. The company has purchased a third building in the area that will bring its AI computing capacity to almost 2 gigawatts. Do you have any color on this, Matt, whatsoever?
No, I mean, just that 2 gigawatts is a hell of a lot of computing
Thank
power,
you for that color.
right? Because we need about 9 gigawatts to run New York City. So that just shows you how much 2 is. And I just love this story because of Elon Musk's pay packages and the targets that they've set, right? Tesla's worth $1.5 trillion and he needs to get to $8 trillion. And a lot of people are questioning how he can do that without producing many more cars. But I think the answer is if you fold in XAI and you fold in SpaceX to Tesla, all of a sudden the market value balloons. And then you could see an $8 billion market cap sooner than you might have expected.
Then you get robots in everybody's home folding their
laundry.
And
then Elon Musk gets $1 trillion.
Exactly. And then there we go. And several gigawatts. I'm losing track of what these metrics really even mean at a certain point. Let's turn back to markets. Bridgewater Associates founder Ray Dalio sat down with Bloomberg to share what he sees as the five biggest risks facing investors in the new year. Take a listen.
I'm a practical investor. I've done this for 50 years. But in order to understand today, I had to understand things that happened before my lifetime. The big cycles, what causes breakdowns of monetary system. So I studied the last 500 years, and there are 5 big factors, 3 of which operate in a big cycle. There is the debt cycle, the debt money cycle, and I'll touch on that in a minute. There is, connected to the money and debt cycle, is the political cycle within countries, the left and the right. Gaps in wealth and values cause populism of the left and the right, which means that there are irreconcilable differences. So we have problems along those lines. And number 3, there's the geopolitical cycle, the world order, when rising powers challenge existing powers and existing systems. Those 3 are interrelated cycles: money, debt, the domestic economy, and the international economy. The 4th is through nature, acts of nature, droughts, floods, and pandemics have been a big factor. They have killed more people than wars, and they can play a role. Certainly, it's playing a role. And then always throughout history is man's inventiveness, particularly of new technologies. And the inventiveness that we're seeing of the new technologies with AI particularly is clearly a force. So now, how does that play out? The first force is that we are having too much debt. Now, this is not just the United States. You're seeing this in England, you're seeing this in France, you're seeing this in China, you're seeing that dynamic. So that they can't increase the debt the way they did before. And then related to that is the politics. When you have these large wealth gap differences, who has the money? And when there's the accumulation of a lot of wealth that then isn't taxed, there's a tendency to want to tax that wealth. And that creates bubbles. In other words, when wealth is very different from money, in order to spend money, you have to sell wealth and get money. And when there's a lot of wealth that needs to be sold. So quite often interest rates play that role. But you could see wealth taxes play that same role, meaning the need to sell that. And that creates a bubble. So we have a debt bubble going on. We have that other kind of a bubble going on in the economy and related to politics. And then, of course, geopolitics. Capital flows and trade flows are different because we have a world in conflict. And in that world in conflict, no country could be secure. So that's why the United States wants to build self-sufficiency in these areas. Or China, which is that model where China would export to the United States and earn money and then invest in bonds, is no longer a viable path because the Chinese worry that they won't get paid on their bonds like the Russians don't get paid on the bonds. So that dynamic is what is behind what's happening, and it's becoming more precarious as we go forward. Like if we go into the 2026 elections, it's likely that the Democrats will take the House. Significant possibility. If that happens, the political conflict will continue to be more difficult, and so on. And that's creating this risky environment. Particularly also, debts are maturing. So you have to roll over your debt at a higher interest rates. This confluence of factors is making the environment more risky as we're going ahead.
Out of the 5 forces that you had mentioned, what do you think is the biggest one that investors are not paying enough attention to?
I think it is the debt service, particularly the government position in the supply-demand of that debt, combined with the politics. What's happening in all of these governments is that they can't increase their spending because they can't increase their debt. And at the same time, they have the needs, more military spending and so on. And at the same time, they can't cut taxes. And so you're seeing a lot of political turnover. In the UK, they've had 4 prime ministers in the last 5 years. Same has been true in France, because there's not the ability to deliver on the economic promises that they're making. So I think it's the confluence of that economics, that situation, and the politics, the debt dynamics working with the politics, working then with this technology adding into it in a bit of a technology bubble.
So final question.
So that concerns me the most. And I would say particularly post-26.
Does that mean that you said recently that 15% allocation in gold and Bitcoin, do you still stand by that line?
I think that everybody should realize that gold is a type of money. It's not something to speculate in, just as you would hold cash. But other cash is a fiat money. And when you have debt, then the government needs to print money and make money easier, which lowers the value of that money. And so also to recognize that gold is a diversifier. When the other parts of the portfolio do badly because of some of the things we're talking about, gold will do better as a diversifier. So it has the effect in such times of raising the returns and diversifying the portfolio. A normal allocation would be between 5 and 15% if you just went into a portfolio optimizer.
That was Bridgewater Associates founder Ray Dalio looking at some of the big risks. And as you point out, Matt, he does have some pretty big risks when you talk about civil unrest and things of that nature, which is the reason why I do think it's notable how many conversations among politicians heading into the end of the year have to do with regulating AI. And I'm talking about both sides of the aisle. How much does that come back as you see a sort of pushback against some of what we've heard from Washington, D.C. so far this year?
Yeah, I've actually talked with Paul Tudor Jones about that this year, and he has warned that we won't get any guardrails on AI because we need to beat the Chinese and other rivals with this technology. Neither side is going to really be able to push through any meaningful regulation. And certainly this administration isn't a huge fan of regulation. But I think Dalio's use of the actual term civil war has been really fascinating throughout this year. And he's said something similar just now in this interview. And he's said as much lately that the left and the right have irreconcilable differences. And it's not just on social issues, but also in terms of the rising government debt, the deficits that are resulting from the latest budget, and the large wealth gaps. I mean, we have a story on the terminal today about the fact that the top 500 richest people in the world have added another $2.2 trillion to their wealth, while the poorest people in this country are not adding to their wealth. In fact, they're getting paid less, and inflation is taking more and more money out of their wallets. So it is interesting to look at those bigger picture, giant macro risks.
I think that we can reconcile some of those differences and say that maybe there should be a holiday period for markets to be on hold from Christmas through the new year. Just suggesting it. I don't know. Do you think that you could get behind that?
Are you still like Dr. Doom on this show?
No, I'm not. I'm actually, you just went totally Dr. Doom, and I'm thinking, all right, well, Happy New Year. Have a good one. I mean, honestly, no, I think that there are plenty of reasons to be optimistic. Always times to worry. You can look in ChatGPT for that one. Anyway, let's move on. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burton. Lizzie.
Hi, Lisa. President Xi Jinping says that China's set to meet its economic targets for 2025, with growth expected to reach about 5%. Addressing the country's top political advisory body on New Year's Eve, Xi said that the economy has demonstrated resilience despite challenges. His remarks were bolstered by official data showing the first expansion in factory activity in 9 months. Elsewhere, COVID-era subsidies that help Americans pay for Obamacare health plans are set to expire today. It'll result in more than 20 million Americans paying higher premiums next month. A handful of House Republicans are joining Democrats in a maneuver that will put a 3-year extension of the subsidies to a vote next month. And Nvidia is looking for help from TSMC to ramp up production of its H200 AI chip orders. According to Reuters, Nvidia has 700,000 H200s, but Chinese technology firms have ordered more than 2 million chips for 2026. TSMC is expected to start work on the chips in the second quarter of the new year. And that's your Bloomberg Brief, Lisa.
Thank you so much, Lizzie. Up next, Goliath is winning.
3 words sum up our view on U.S. banks. Goliath is winning. Will big banks do well in 2026? And I think it's pretty clear that the answer is yes.
Chris McGrady of KBW joins next. This is Bloomberg Surveillance. A bit of softness to close out 2025, at least if this holds. It would be the 4th straight session of losses. But we are building back from some of the losses before, down 0.1% on the S&P. A bit of a rally into the long end of the yield curve. 10-year yields now 4.11%. A real question of who's going to lead come 2026. And under surveillance this morning, Goliath is winning.
3 words sum up our view on U.S. banks. Goliath is winning. Goliath is winning like never before. The simple question is, will big banks do well in 2026? And I think it's pretty clear that the answer is yes. They're in a period of deregulation. The banks that are most regulated should get benefits.
Here's the latest. Healthy capital markets are the driving force behind the strong U.S. bank performance in 2025. Chris McGrady of KBW sees that continuing into the new year, writing, "We see further momentum and outperformance in 2026 as multi-year structural tailwinds for capital markets and capital return further unfold." Chris joins us now for more. Chris, great to see you.
Good morning.
Happy New Year. Good morning. I just want to start with the Goliath question. Do you think that Goliath is going to win next year in the banking space?
Goliath is winning, right? And if you take a step back, like at KBW, our theme is the KBW Triple Crown, which is scale, consistency, and deregulation. All these forces, we believe, favor the largest banks. You've seen it in the stock performance. You've seen it in the earnings revisions. And we see no reason why that won't continue.
How much do you see a potential risk with credit concerns that peaked up with Tricolor and with other select defaults in 2025? Is that something that will become even more of a story in 2026?
Credit's the number one thing that can ruin the momentum, right? And we saw pieces of that in October. We saw 3 high-profile credits go south. What was interesting, Lisa, is the performance of the banks when that happened, right? The largest banks had the exposure. JP Morgan had exposure. but it was absorbed by the revenues and the momentum elsewhere in the franchise. And you take a company like Zion's, a mid-cap that had $50 million of exposure, and they lost 10x in their market cap in those couple of weeks. So it just shows you that high degree of sensitivity. But if you look at credit spreads, if you look at credit conditions, the banks have done an exceptional job passing that test.
I actually just pulled up on my Bloomberg terminal a year-to-date chart of JP Morgan stock versus Blue Owl Capital. Because Blue Owl has become kind of the poster child for these private credit companies, rightly or wrongly, it's down 33% this year, and JP Morgan is up 38%. And, because of the discussion about cockroaches and the back and forth between Jamie Dimon and Mark Lipschultz, it makes it all the more interesting. Does that continue, or do you think we're mispricing private credit here?
It could be a little bit of both. I think what we've seen from the private credit perspective of the past 5 years, if you back up, is a lot of the loan growth that normally would end up on the bank's balance sheet has moved to private credit. Now, part of that is regulation post-financial crisis. So I would say following a crisis, there's a tendency to overregulate. And we're seeing some of those rules get relaxed. But there's definitely an arbitrage between the banks and the non-banks.
And I can back out to 5 years because the comp function does that, and JP Morgan has tripled in that time. So, these big Wall Street banks, especially heading into the Trump 2.0 period of deregulation, just stand to benefit even more, don't they?
They do. The scale's winning, right? If you look at JP Morgan, we think JP Morgan is a growth company. It's an unpopular, unconventional view, given it's the largest bank in the world. But JP Morgan is growing top-line revenues at a high single-digit rate. It is growing expenses slightly less, so there's operating leverage in the model. But JP Morgan and the largest banks, they've developed these models. And what's interesting over the past 10 years is when I started my career 20 years ago, the largest banks traded at the lowest multiples because it was too big to grow. Or too large to grow. Now it's the opposite. The largest banks trade at the highest multiples. And I think what's interesting is they've developed and produced the most consistent returns and the moat around their businesses across all the business.
This has happened at a time where volatility is really low. And you're seeing this in the bond space. You're seeing this even in equity implied volatility. The Fed is still expanding its balance sheet in order to counter certain liquidity concerns heading into year end. Is there a fear that if we do get some sort of spike up in volatility, that could dramatically shift the landscape?
It could. Credit spreads are low. We've seen, capital markets be exceptionally healthy. But if credit spreads were to go the other way in 2026, or we see some period of volatility, that will understandably be an excuse to probably sell banks, right? I think capital markets has been a huge tailwind. And as long as the capital markets are functioning and we see a healthy IPO pipeline, we see a healthy M&A pipeline, that could disrupt it. But again, we're in a pretty good spot.
It seems like the risk versus greed paradigm is really shifting toward the greed in terms of what companies get rewarded for. Do you think that when banks report earnings come January, they will get rewarded for expanding their balance sheets? They will get rewarded for even increasing their pool of credit reserves for charge-offs as they expand to try to get more profits?
I would say growth has been the missing link for the space, right? If you think about the 200 plus banks that we cover at KBW, loan growth has been tepid, right? It's been a source of deleveraging. It's been the intermediation of private credit. As we see 2026 guides be unveiled, I think we will see decent guides. I think we will see conservative guides with room for upside, and it's going to be upside from margin expansion, capital markets momentum, and deregulation.
Yeah, well, Chris McGratty of KBW, thank you so much for being with us and have a wonderful new year. Great to see you in person. A real question of whether the U.S. can outperform Europe as well, because European banks have really done absolutely tremendously so far this year, Matt.
Yeah, far better. I was just looking at price to book, and Deutsche Bank is more than 1. I spent 6 years in Germany when it was like 0.3. And we've seen in Madrid, the banks outperform to the tune of 50% gain for the IBEX. So it's pretty amazing to watch.
Yeah, the expansion of credit there continues to build. Although the IBEX in Spain has done absolutely tremendously. I think it's been their best year since 1993. When you take a look at the returns there to Spain, there's something in the Spanish water. I think you're going to be.
If you're a dollar investor, it's even better.
Exactly.
Right?
Yeah. Well, maybe we can all get some jamon. Coming up in the next hour, Margie Patel of Allspring Global Investments, Becky Blaine of The Points Guy, Claudia Sum of New Century Advisors, as we take you toward the last economic indicator of 2025, the jobless claims that come out at 8:30 Eastern, and Whitney Caesar of Credit Sites, where we could talk all about the credit profile, particularly how it's transitioning with some of the AI influence. From New York, this is Bloomberg Surveillance. Good morning.
kind of see shades of this K-shaped economy, K-shaped market.
Instead of any sort of dramatic surge that could reignite inflation pressures, we will see hiring activity slowly start to pick up.
If employment keeps weakening, if inflation kind of stays somewhat cool, it's hard to imagine that the Fed doesn't cut more.
What matters is how the interplay of the risks and the tailwinds are going to interplay in 2026.
2026 is really about adaptability.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance on this New Year's Eve. Stocks on track for a fourth straight day of losses, with traders lacking a reason to shift around their equity holdings after a pretty big year. Some big moves, though, still out there, particularly in precious metals, with escalating volatility prompting CME Group to hike margins for the second time in a week, and in just about a half an hour time, getting the final economic release of 2025. Jobless claims due out in a half an hour, with Fed officials signaling 2 more rate cuts to come in 2026. Matt Miller alongside me right now, as we do see fireworks going off in Sydney, Australia, because it is a new year already. It already is 2026. First, we got Auckland, now New Zealand, now we've got Sydney. It already is the new year, Matt.
Yeah, we'll be rolling fireworks around the world. This morning, I'm going to see Tokyo and Seoul at 10 o'clock New York time. And it's been a pretty good year for stocks around the world, too. Globally, remember, many of these markets have outperformed the U.S., and we've done very well with a 17% gain on the S&P 500. If you compound the gains over the last 3 years, actually 80% for 23, 24, and 25. So it's been an amazing run and added a ton to global wealth.
Yeah, although some people have pointed out that you've seen even bigger gains in the likes of Germany, with the biggest year going back to 2019, led by defensive stocks, as well as some of the other shares of the likes of Deutsche Bank. You also have seen Spain deliver its best performance since, I believe, 1993. Other superlatives for the year: the dollar, on the flip side of some of that equity outperformance internationally, has been weakening at the fastest pace going back to 2017. Watching that space closely, it's also been the biggest year for gold and silver going back to 1979. This is setting up 2026, which we are already entering in the down under. Does this continue in terms of U.S. exceptionalism being challenged by the international landscape?
You know, I ask that question of guests on my show all the time, and the answer is inevitably yes. Many investors think that overseas, especially EM investment, is going to pay off better than U.S. investment. What do you hear here on Surveillance?
I think it's a motley picture. Some people say that that is the case and that you do see diversification. Other people saying that that is a trade that depends on the waning of the AI trade. And as long as you get a waning of the AI trade, the rest of the world should benefit if you do get that broadening out. That is one of the biggest questions. Also a big question with oil at the worst year going back to 2020. Do we see a continuation of that? Right now we are seeing stocks just coming off. Bond yields really getting bid this morning, 4.11 on the 10-year. Coming up this hour, Marky Patel of Allspring Global Investments, with stocks on track for a 4-day losing streak to end the year. Becky Blaine of The Points Guy expecting a more stable airline environment in 2026. And Claudia Sam of New Century Advisors breaking down the latest and last jobs data of the year. We begin this hour, stocks just edging lower, with Marky Patel of Allsprings Global Investments writing, "We do not expect the stock market to broaden out materially in 2026. We think the strong sectors will continue to have high growth." Marky joins us now. And Marky, thank you so much for being with us. You really are answering the question that Matt was just asking, which is how much do you see this outperformance of the rest of the world, of the rest of the 493, really taking hold next year?
Mm-hmm. Well, I think for the rest of the world, it's really sort of a catch up after a long period of underperformance. And I think that the U.S. still has some of the best fundamentals of any country in the world. And we have good momentum. Really this year, we saw it in the third quarter. That should continue in the fourth and well into next year with the tax treatment, lower withholding, higher refunds, and the very favorable capital expenditure treatment in the new tax bill. So we think that the U.S. is going to be one of the better performing sectors next year in the world, really.
And it does hinge, in your view, on AI remaining the dominant trade. How much is this on a currency-adjusted basis versus overall in absolute terms?
Well, I think the artificial intelligence trade is going to continue, but really over the last few months, we've already seen some erosion in the price earnings ratios of some of the leading companies in AI. So the market is already making an adjustment if we're looking at some moderation from the extremely high growth, which is probably likely, but still that says to me that's going to be one of the sectors that have well above average growth when you look at the whole economy. So we still think that's a great sector.
What kind of broadening out do we get in earnings, Margie? Because we have seen the Mag 7 earnings, though still, massive double-digit gains, slow down, and the rest of the S&P, as Lisa says, the S&P 493, starting to catch up to some extent, but it hasn't really been substantial. Does that change in 2026?
No, I don't think so. I think the same sectors that have been strong for this year and a couple of years before are going to continue to be strong. The other sectors that I think particularly for consumers may be rather disappointing. So we still think it'll be technology, industrials, relating to the electrical grid. And those will be the sectors. And aerospace defense will continue to be the strong sectors and really outperform those other sectors.
We've seen, year to date, all of the GICS sectors on the S&P 500 are up, but real estate has barely budged. I wonder if that changes with interest rates coming down. Consumer staples is the second worst performer, and energy, oddly enough, is the third worst performer, I guess because of oil, right? But we're going to need so much energy to power these colossus data centers. Why doesn't it pay off?
Well, I think really when you look at the data centers and the growth in power that we need in this country and other countries really is going to come from the gas side. So we think that gas will continue to be in strong demand and really detached from the price of oil. And when you actually look at oil, although there seems to be a glut today, if you look down the road a year or two, it may look like that the countries producing oil have really been underinvesting. So we may have, not today, not tomorrow, a year from now, have a big surprise to say, oh, we really need to invest more in oil. But we think the case for gas, especially in the U.S., the shale producers feeding into the electrical grid and the need for more power, it's really the only realistic source, is going to make that sector very strong and really detached from what happens to the price of oil.
How much, Margie, does this really lean into the whole real world economy, the old world economy, being dominant? We've seen that to some degree with the metal space so far this year. Do you expect that to continue next year?
Yes, I think so. And I think the U.S. is going to continue to be one of the strongest economies, particularly because the fundamentals are really on our side. When you look at the emerging markets, a lot of them have had a big comeback, but fundamentally their economies don't have what we need to really see the sort of sustainable growth. In the U.S., it looks like we're on track to say 2 or maybe 3% next year, which would really put us near the high end of the range of sustainable growth around the world.
I know that back in the day, Margie, you and I used to talk all the time about high-yield bonds and investment-grade bonds and how fixed income fit into a portfolio. Increasingly, you've talked about how equities have been a better proposition for a risk-on move and, frankly, for returns than bonds. Do you think that that's going to shift come 2026?
No, I think the bond market is a place of very small risk and very moderate returns. So you'll get, particularly in high yield, a little bit extra yield, maybe 2 percentage points, maybe 3 percentage points more than the Treasury yield. So say 5.5 to 6 3/4, something like that. But you really can't look for much beyond that. If you look at the high yield market, a lot of the poor quality issues have been siphoned off, gone into the loan market. So the U.S. public high yield market has a default rate only of about 2%. So it's actually quite safe on a relative basis. And the defaults have been more on the private credit side, which are more than twice that amount. And we think that'll continue. And as I said, there's no room for capital appreciation because most bonds in the high yield universe are trading above their face value. So we can't have the old fashioned capital appreciation that we would talk about in years past. It just isn't, the math just isn't there.
Margie, I'm just an equities simpleton. So this is a little bit too much for me to understand. Why do we have credit metrics getting better and better? Torsten Slok put out a note about it today, and defaults falling at the same time as bankruptcies hit the highest level since just after the great financial crisis. How does that work out?
Well, because the public high yield market Number one, they have not gotten the poor quality issues they may have in other years because those have been siphoned off into the private credit market. So you just don't have those very vulnerable names. And secondly, during that period of zero interest rates, many high yield companies took advantage of that to restructure their balance sheet, to pay off their bank lines, to issue new debt at very, very low coupon rates, pre-refund issues that might be callable or coming due in a couple of years. So actually, the high yield bond market as a whole has never had such a strong balance sheet overall. And secondly, the supply is really pretty modest compared to the insatiable demand for higher yielding securities. So we think the high yield market is a little, I would say, an island of tranquility, but it really looks pretty good. The only criticism is you aren't going to get those types of equity-like returns that we've seen in other markets, especially if the Fed is very much on even keel, relative stability. It'd be a different case if the Fed were going to slam on the brakes, jack up interest rates, but that doesn't look like that's on the horizon at all. So we think the high yield market, for what it is a modest yield, modest risk, and some investors like that. And that's so for that, it's a good sector.
What does this mean for private credit, Margie, as we go into 2026 and I see all of these non-bank lenders in Blue Owl, Apollo, KKR, Blackstone, underwater for 2025. They haven't performed for equity investors.
Well, and that reflects the fact that many of transactions that were done were in the poorer quality companies that really don't have the ability to improve their balance sheet, to raise their growth. And it was really just sort of a play on spreads of the cost of money versus what they get. And we think that'll continue. And actually, that's a market that is now larger than the U.S. high yield market. It's more than doubled in the last 5 years. So it's really a case of that's where all the marginal dollars have flowed to. And so that will be where the marginal risk will be. And I think that, as we've seen, when there are bankruptcies or blowups in that market, it really hasn't washed over into the bank sector, hasn't washed over into the high yield market with spreads widening out, because the market has distinguished those companies that are under pressure, got way too much money, from the high yield market, where it's more of a because of the better balance sheets and the credit outlook and moderate use of funds. When you look at high yield bonds, the purpose of why they're borrowing money, more than half, maybe even close to 3/4 of the last few years have been to refinance other debt. So they aren't going crazy with paying themselves big dividends or to make acquisitions that will turn out to be too risky. So that says it's a very attractive sector looking at the fundamentals, really.
Margie Patel of Allspring Global Investments. Wonderful to see you. Thank you so much for being with us. Have a wonderful new year. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
Hi, Lisa. Tatiana Schlossberg, the granddaughter of former President John F. Kennedy, has died at the age of 35. She had disclosed and detailed her battle with acute myeloid leukemia, a cancer of the blood and bone marrow. Schlossberg was an enterprising journalist who wrote for the Metro and Science desks of the New York Times before transitioning into freelance writing. Elsewhere, Warner Brothers Discovery is planning to reject a takeover bid from Paramount after the company amended the terms of its offer. Sources telling us here at Bloomberg that Warner Brothers board will meet next week to make a final decision. The board is concerned that Paramount has yet to increase its offer, which was earlier rejected as inferior to one from Netflix. And Michael Burry, the money manager, who is, of course, made famous by The Big Short, denying being short Tesla shares, despite calling the company ridiculously overvalued earlier this month. Burry's comments come after Tesla took the unusual step of publishing a series of sales estimates indicating the outlook for its vehicle deliveries may be lower than many investors were expecting. And that's your Bloomberg Brief, Lisa.
Thank you so much, Lizzie. All right, Matt, you're a car expert. So what do you think of the Tesla? Do you kind of get into the electric if they had an electric truck or an electric motorcycle?
I increasingly hear positive reviews about the Cybertruck. I have not driven one myself, and I think they're horrendously ugly. But I applaud the company for taking that kind of brave step to doing something different. And so I think it's pretty cool.
Yeah, although I have seen people with Cybertrucks not allowed into passing lanes because people are not very happy with the Cybertruck. I've seen that in a variety of places. Have you ever seen that?
No.
Okay.
No. Well, in general, U.S. drivers don't allow anybody
That's
into the
true.
left lane.
That's true.
They get in the left lane and drive very slowly.
People tend to be a little bit less than polite there. Up next, the morning calls plus Becky Blaine of the Points Guy expecting less turbulence for the airline industry in 2026. That's coming up next. This is Bloomberg Surveillance.
When you think about some of the dynamics that we're seeing in terms of supply, we have immigration that's falling. We have retirements that we think continue to accelerate. At the same time, your demand for labor, while slowing, still hanging in there. So what that means is you're going to have a situation where the need for workers is still there. It's just showing up as replacement demand. So payrolls aren't going to look great by any means, but we are going to expect an environment where the unemployment rate remains low.
That was Michael Reed of RBC speaking earlier as we do wait to get that jobless claims number at 8:30 Eastern in about 12 minutes time. Right now in markets, you are seeing just a touch of softness in the S&P. Futures down by about 0.1%. Euro dollar stuck there around 117.53. 10-year yields now higher, which is sort of interesting given the fact that they were lower earlier in the session. They are selling off 4.13% rounded off. Remember that they started the year at 4.55%, and crude firming up after the worst year going back to the height of the pandemic. Time now for the morning calls. First up, Citizens raising its price target on Alphabet to $385 from $340, while maintaining an outperform rating on the shares. The firm expecting Google to accelerate search revenue in the fourth quarter, down about 0.25% in pre-market trading on Alphabet shares. Next up, BTIG raising its price target on TKO Group from $235 to $250 and keeping a buy rating on the shares. The firm seeing additional upside in TKO's sports and live entertainment businesses in 2026. Can you say TKO?
TKO. Technical knockout.
TKO. I'll try to get it again. It's sort of, punch out, right? Isn't that what it is?
Technical knockout.
Okay, thank you. Technical knockout. I'll just call it technical knockout company. And finally, Jefferies raising its price target on Vanda Pharmaceuticals to $7.50 from $5, while maintaining its hold rating on the shares. The move coming after the FDA approval of Vanda's new motion sickness drug. Those shares up almost 20% in pre-market trading. Turning now to travel. Winter storms testing the U.S. airlines as holiday travel wraps up a volatile year for the industry. Becky Blaine, senior editor at The Points Guy, joins us now. Becky, it feels like this happens every year. Is this year any worse in reality with storms and cancellations?
No, this year hasn't been any worse than previous years when we look at some of the travel hiccups and headaches that we've experienced across the U.S. You've got those summer thunderstorms you can always count on. You've got winter weather. And what matters, though, is the resiliency of the traveler and if they're willing to get back out there again.
Are there any airlines that do better, that outperform in bad weather historically?
Right now, it looks like Delta has been kind of the leader in on-time performance and reliability, and they have a really good outlook going into 2026 as well. And every year we put out our best airlines report at thepointsguy.com, and so you can always read how those are ranked as well.
So is Delta typically one of the best? I mean, every airline is pretty bad, because they just try and pack, for profitability reasons, obviously, as many people as they can into a tiny little tube. And then, most of the seats aren't lie flat, even if you
joyful today,
even if you go to Seattle from New York. Are there any, though, that are better than the rest? Is Delta one of those that outperforms in terms of customer satisfaction regularly?
Delta does. And I think United is up there as well. One of American's big goals for 2026 is to work on its customer service. and increase its profitability there with on-time performance as well. And so what we're seeing though with a lot of these carriers across the big three US carriers is they're increasing their premium product offering. There's been a demand for it from the US travel market, especially when you look at those outbound international flights. That's where demand is strongest right now. We've seen inbound travel, drop off this year due to a variety of reasons, including government shutdown, immigration policy. And so that outbound, though, remains strong. And the airlines are really counting on that going into 2026 and increasing that product. When you look at I was just looking at airline prices the other day to go to Europe in 2 weeks. And I saw a premium economy seat for $5,300, but you could fly first class for $3,000. And so that gives you just a little bit of an indication of what the US market is demanding. They want that better than economy, maybe not willing to pay first class price, but sometimes you'll find a deal like that because premium economy is in such demand right now.
Matt, when was the last time you went on vacation? I'm just curious. I mean, you're just yelling at a cloud this morning.
Well, no, because I'm 6'3", right?
Okay.
And unless I pay for a business or first class seat, it's just an awful experience. I mean, there's no attempt by airlines to make it any better for American-sized people.
Okay.
And
TSA,
that's because they need to please obviously shareholders and make as much money as possible, which is fine. If you're an investor, I get it, but if you're a customer, it's not a great experience.
It's also though about traveling to places where you can do fun things like ski, like be on a beach. And I am wondering, Becky, from your standpoint, whether you are seeing better incentives, the idea of miles or other points that people can get from airlines, from their credit cards. Are those still carrying as much heft, or are you seeing a real inflation in some of those areas?
We've seen some program devaluations over this last few years, but you have to remain nimble. And one of our best pieces of advice at the Points Guy is to leverage points and miles in a program that you're going to earn and use the most. I'm a big fan myself of transferable rewards, so I might double down on American Express membership rewards or Chase Ultimate Rewards points, put my spending on those cards, and then I take those points and transfer them to the airline. So to Matt's point, if you want to fly in a premium seat, like I've flown long haul overseas to Europe from the West Coast for 50,000 miles in a lie flat seat on Air France. Now those seats run about 60,000 miles one way, but still, those deals are out there. Matt, we're going to sign you up for our daily newsletter.
Those are few and far between. I mean, come on. That's very unrealistic.
You could fly in a lie flat seat from New York to London on Virgin Atlantic, starting at 6,000 points. Well, economy is 6,000. You can fly upper class for a little bit more than that. We're talking like maybe 24,000 miles or points there, depending on what program you're transferring from. So you just have to know where to look and how to look and who the transfer partners are from the different credit cards. And usually like a one-to-one transfer direct into the airline might not be the best use of your miles or your points. I might look at American Airlines, and I'm an elite traveler with American Airlines. I have been for many years. I look at some of their redemptions, and they want 400,000 miles for a seat that I can transfer and book through a different program and maybe pay 60,000 miles or points for.
Becky Blaine of the Points Guy, I look forward to you making Matt a happier guy with the newsletter that he receives, and it comes up with some deals so that you can actually travel without raising your fist.
Dress codes would be great.
Oh, my
if an
goodness.
airline would instate, because what's the deal with sweatpants and Crocs?
It's comfortable, and you have to take your shoes off. I guess not anymore, but if you have to take your shoes off, you're going to ban sweatpants. What, you think everybody should dress in a suit?
I think, you've got to dress for the occasion, especially if you're going, for you, right? If you're going to go skiing in St. Moritz or whatever, then you should wear a coat and tie.
A coat and tie? I should wear a ski outfit, or I should wear your jacket. I'll wear your jacket next time I fly to go skiing. Coming up, less of that, the more of this. The latest jobless claims data is set to cross with the last economic indicator of 2025. Claudia Sam of New Century Advisors with us to break down the numbers. This is Bloomberg Surveillance. Right now, about an hour away from the open, and we do see a soggy start to the day, the fourth potential straight day of losses to end 2025. Right now, what you do see although we are clawing back from some of the earlier declines, down about 0.1% on the S&P. When you take a look at the bond space, 2s, 10s, and 30s, a real question about whether the Fed has the space to cut rates and what this means on the long end. A bit of a sell-off as we wait for the latest jobless claims, which we are just getting now, and they come in below expectation, 199,000 versus the expected 218,000 unemployment claims. They also was a slight revision up, but basically flat on the prior week, 215,000 from the previously stated 214. Continuing claims people have been watching as a sign of how much people who are unemployed can actually get work. It does look like the continuing claims came down to 1.86 million. Down from 1.9 the previous week. So we do see declines. And Matt, this really does speak to the ongoing quiet in the labor market, that things don't seem to be falling off a cliff, despite some of the concerns that have been out there.
Yeah, I think it's fascinating. You know, you get down below 200,000, and that has only happened a few times in the last 4 years. But we have been stuck in this range with initial jobless claims since the end of 2021. We have been stuck between 200 and 250,000. Ed Hyman once told me it was the most reliable piece of economic data that comes out on the Bloomberg terminal. But I don't know what it means when it stays the same number every single week, right?
You're not alone. And I think that's the reason why you aren't seeing a massive move, although the 2-year yield is popping higher, up 1 basis point on the back of this data. The unemployment claims, definitely something that has remained fairly stagnant, although the continuing claims has caught some people's attention because that had been ticking up. So a good sign that we have seen that come in. Claudia Sahm of New Century Advisory joins us now to give us some insight. Claudia, thank you so much for being with us, and Happy New Year. Yeah. What do you make of this? Matt's point that we've seen unemployment claims basically at the same place for almost a year.
Right. So, as you said, we're not seeing signs of deterioration in the labor market. Like, the layoffs have not picked up in a way that was the downside risk that the Fed has been very acute to. And we haven't seen that. So we're not seeing the bad news story. Frankly, we still need to see some good news in the labor market. So the claims don't get at the piece that's really been sticky, and that's that the hiring rate has been quite low. So yes, good news on the continuing claims for this week, but they are still quite elevated. And so we need a little bit more of the good news. But, the fact that the layoffs have not shown up despite a lot of layoff announcements, like, we're not seeing them in terms of actual layoffs, and that's good news.
Claudia, do you take anything from the idea that continuing claims came in to some of the lowest levels that we've seen going back about a month? Not significant, and they are elevated, as you've said, but does that indicate that people are actually finding work?
It's possible. These are, while the claims data are very timely, we get a quick read. We have to be careful around the turn of the year. It's just really tricky with the holidays, and, just reading these data is much harder at the turn of the year than, say, in the middle of the year. But it is potentially a good sign. And what we're looking for are signs of more stability in the labor market, signs that the hiring rates start to pick up off their very low levels. So this is encouraging, but this doesn't make the case yet, right? We need to see it in the hiring data.
Claudia, what does the labor market look like with the stop in immigration, no new people coming to the U.S., and the demographics, fewer and fewer people having babies, or people having fewer babies? It would seem to me that if you have the economy growing, and we do, and corporate revenue and profits growing, as we do, that lack of supply in the labor pool would mean more demand. But it doesn't look like that, as you point out.
Right. Well, there are all kinds of timing issues, right? It is quite unusual. We saw, in the third quarter, GDP really, moved up higher, and so did the unemployment rate. right? In a much less dramatic fashion, but it is moving higher. And so, you have the ingredients for the good news story of the labor market going into 2026. Consumers are still out there spending. You've still got the business investment. Companies will need, as they expand, to draw on their labor force. And we should see, and I think this is the optimism that you can kind of see in the minutes from the Fed's December meeting. There's an outlook there that these pieces should come together and we should have hiring pick up. It doesn't necessarily need to pick up to levels that we saw, 2-3 years ago when immigration was much stronger. But we are at low levels that we have seen wage growth slow some. We've seen the unemployment rate tick up. That is a sign of the demand for workers is just lagging behind the supply.
Diane Swank pointed out a couple of months ago that cutting rates, the Fed lowering rates, isn't going to help consumers in the lower quintile, because subprime rates don't come down with the front end of the curve. But I wonder if it does help the labor market. We've lost, I think, 70,000 manufacturing jobs this year. We've got a ton of incentives in the one big, beautiful bill to, I guess, bring those back, and tariffs are supposed to do that too. If those things don't work, does cutting rates help to bring back manufacturing jobs?
Well, cutting rates is supportive of both households and businesses in expansion. I mean, and in particular, say smaller businesses that, the interest rates that they borrow with, that's a key, calculus in their decision to expand. And as they expand, they can bring on more workers. So, we shouldn't have the view that the Fed has the magic wand here on the economy and it's going to, on its own, revive the labor market. But the Fed pulling restriction out of the economy, it helps. It moves in the right direction. And again, it's a piece of the puzzle. There's also more fiscal support coming early in the year. And it does appear that uncertainty just broadly about policy and maybe some of technological change has weighed on the labor market this year. And as that dissipates, that's also another ingredient to kind of get hiring going again.
Uncertainty has also been pretty strong because we haven't known how much we can trust the data or whether we're going to even get the data. And even in this latest batch of numbers, one terminal user points out that seasonal adjustment, if you strip that out, you actually see initial jobless claims that are higher than the previous week. So what do you make of these types of seasonal adjustments, of these types of calculations that have raised more questions than given answers?
Right. Well, these issues with seasonal adjustment, these are the mainstay of trying to read macroeconomic data, right? Like, as I said, around the turn of the year, claims data are tough. From Thanksgiving into early in the year, it's just that's just a hard read. And so you do a lot of averaging, kind of look at the basic trend. And the basic trend looks pretty good, right? So don't make too much out of 1 week. But yes, these are our regular issues. Unfortunately, we're also dealing with, the backlog of the government shutdown and data collection having been very disrupted. And even as we're getting data, and the claims data, this does not apply to them, but say like the CPI or the labor market data, the shutdown casts a long shadow. Like, we have distorted data in a way that we don't typically have distortions. We don't typically lose a month of data and then try and pick up the pieces afterwards. So it does make it more complicated. But, thankfully, there's a lot of information out there. You just kind of, pull it all in and get a sense of what's going on. And really, the tenor of the data in general is pretty good. I mean, solid. There, like I said, we still need the labor market to pick up, but the ingredients are there.
When I want to feel good, I walk down the street and I see all these people going to stores and being together and going to work. And when I want to feel bad, I read the news. And I read all these stories about how computers are coming for our jobs and how a lot of places are seeing opportunities to replace human labor with algorithmic programs. I'm just wondering, based on the data that you've been looking at, how much credence is there behind this sort of replacement concept of AI?
Well, I think looking at surveys, industry level data, when we think about the labor market being somewhat slow right now, I don't think that AI really can, you can point to that as a key driver broadly. There are some industries in tech, increasingly in finance, where you see more adoption, and there probably are cost savings happening with employers. I think, it does fit into this piece of the broader uncertainty, right? Like, do you need to hire? Do you need these workers? That's much harder to parse out of the data because there's a lot of different sources of uncertainty right now that businesses have. But in terms of, the adoption really holding back the labor market, I think it's hard to point to a broad story, but it is certainly something to watch. But we should also remember that the new technology also enables new jobs and new uses of technology. So it's not just about saving labor, it's also about making labor more productive. And that can be a real good news story over the long haul.
Claudia, I love when you're on because I learn so much from you and because of your notable achievements in economics, but also because you went to Denison and I spent a year there. My dad went to Denison, my mom went to Denison, I grew up in Granville. What do you think of the value of a college education for the average American these days? Because so many, not just kids, but adults are having trouble meeting repayment requirements well into their 40s, and it doesn't look like recent graduates are getting a huge advantage in the jobs market.
Right. Well, technical skills and training they're always important for getting ahead. They do pay off. I have a very ecumenical view. I had an excellent education at Denison University, a liberal arts college, but that's not for everybody. My daughter's in engineering school at Illinois. She's, different technical training. And I think, in the trades, and there are lots of ways to gain skills. And we certainly don't want to push every child through a college education, particularly with the cost of it. But it doesn't, I still think, and the data bear this out, like the education and the skills, they do pay off.
Claudia Sahm of New Century Advisors. Wonderful to see you. Happy New Year. Thank you so much. See you in 2026. Matt, to your question about college education, having just gone through that process with my oldest, I will say there is this interesting calculus that I didn't find myself making when I was a kid. Do they have job programs to get kids into jobs during, whether it's the summers and internships or not? That's an increasing focus from pretty much every college we visited. So to your point, definitely this is on their minds as well.
And it's so much fun, right? College. It's
Not
such
if
a
I
blast.
can help it. Not mine. Anyway, Matt Miller, thank you so much for joining over the past hour and 45 minutes.
Happy New Year.
Happy New Year. Love the outfit. I look forward to you in a kilt next year. He's heading over to the radio studio, and he'll be taking you through the next 3 hours on TV and radio, just because he hasn't had enough and he wants to really enjoy his heading into the new year right now. By the way, I really love the jacket.
Thank you.
Are you going to switch it out to different jackets throughout the day like Mr. Rogers?
This is just a New Year's thing.
Okay.
So, but yeah, next year, if we have double-digit gains again, I will be on this program in a kilt.
All right. Right now, we can hold him to that. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
I don't know how I'm going to concentrate with the thought of Matt Miller's legs in my head in a kilt. But moving to the news, we've got Elon Musk's XAI purchasing a third building in Memphis to expand its data center complex. The billionaire wrote on X that it will bring the company's AI computing capacity to almost 2 gigawatts. Musk has publicly discussed the plans to build the world's largest data center for AI training, and posted earlier this year that Colossus 2 will eventually have 550,000 chips from Nvidia. Now, if you're hoping to get a Trump mobile phone, you're going to have to wait a little bit longer. According to the Financial Times, the phone company launched by the president's family business won't be available by the end of this year, as originally planned. The company telling the FT that shipments of the $499 gold-coloured phone were delayed by the recent government shutdown. And revelers wanting to celebrate the new year in New York's Times Square will need to bundle up. New York City temperatures are projected to drop as low as 26 degrees Fahrenheit, with a chance of snow later in the evening. Meanwhile, on the West Coast, there's a rising risk of flash floods in Los Angeles, and there's a near 100% chance of a wet New Year's Day rose parade. That's your Bloomberg Brief, Lisa.
Thank you so much, Lizzie. As you pointed out, people will still have a good time. And it's December. Of course, it's going to be cold in Times Square. Lizzie will be back with us in just a little bit with your morning movers. Up next, Winnie Caesar of Credit Sites breaking down artificial intelligence's growing share in the public credit markets. Lizzie's going to be taking a look at Nvidia, up on reports that it's pushing for an increase in H200 production over for Chinese consumption. This is Bloomberg Surveillance. Good morning.
biggest risk is that the Fed has to consider raising rates at some point over the course of next year. That would be the biggest shift that could potentially throw a wrench into the low vol and easy financial conditions and high overall base metal price conditions that we are currently seeing today.
That was Mark Cabana of Bank of America talking about the year ahead outlook and the potential for more rate cuts. Right now in markets, you are seeing a new color. After 3 days of red, you are seeing some green, although marginally so, after the jobless claims came out below expectations, essentially flat on S&P and NASDAQ futures as well as Russell 2000 after 3 straight sessions of losses. Meanwhile, in the bond space, a reversal there as well. You can see the 2-year yield in particular now up 2 basis points after having been lower by a basis point to 3.47%. You are seeing the sell-off in a similar fashion for the 10-year at 4.14%. And that 30-year yield ending higher than where we began the year, 4.83%. So we are seeing that yield curve steepening for 2025. Under 1 hour away from the cash open, let's head over to London with your morning movers with our very own Lizzie Burton. Lizzie.
Hi, Lisa. Well, I want to start in the chip space now because we have had the news from Reuters that Nvidia has been sounding out TSMC to help ramp up production of its H200 AI chip. Now, we don't know how many units it would be ordering, but what we do know is that it's got about 700,000 in stock and about 2 million ordered by Chinese tech firms for 2026. So Reuters reporting that it's going to be TSMC that helps fill that gap and the work to start in the second quarter of 2026. So both of these up in the pre-market. But if you flip the board over, you've got losses in the pre-market for AMD and Micron. We did earlier. They flipped into the green, like me. So it's actually not such a mixed picture in the chip space. Everybody looking to end 2025 in the green. Let's flip over now to Nike as well, because we've had the CEO, Elliott Hill, buying $1 million worth of shares. This following on the footsteps of the Apple CEO, Tim Cook. He bought 3 million on Christmas Eve. So that stock liking it, the shares up nearly 3% in the pre-market. Happy New Year to you, Lisa.
Happy New Year to you, Lizzie. In green, bringing the market with you as you speak. Right now, counting you down to the opening bell. Here's a trading diary for the week ahead and the start of the new year. Tomorrow, markets are closed. Happy New Year, and thank you for being with us. Next Wednesday, we get data, ADP data, JOLTS data, and ISM services. Thursday, another round of jobless claims and the trade balance. And on Friday, this is a biggie, the December payrolls report and University of Michigan consumer sentiment. Turning to the tech story that has been the dominant story for 2025, AI-related debt issuance in public markets is doubling this year as build-out costs surge. Winnie Caesar of Credit Sites writing, with spreads still very tight, we are maintaining our cautious view on credit risk and prefer taking duration risk. Winnie joins us now for more. And Winnie, thank you so much for being with us. How much has the increase in AI-related issuance increased the riskiness of the investment-grade debt market? I think that, Winnie, if you could just stick with us, I believe we are not getting your sound. We will get back to you in just 1 second. Just to point out how much the returns have been. If you take a look at investment grade credit markets, you have seen an 8% return so far this year. In the high yield space, you have seen more than 9% returns so far this year. Spreads have tightened. That means the extra yield over benchmark rates. As people take a look at credit profiles that have looked better than expected, in particular because of what we have seen with just companies terming out some of their debt structures. But in the investment grade credit space, and this is something that Torsten Slok pointed out not so long ago, you have seen an increase in AI-related issuance to about 14% of total investment grade credit issuance in 2025 versus 7% of issuance in 2024. This has raised concerns about AI being the dominant theme and frankly, overwhelming every trade in the market, whether it's in equities or whether it's in credit. This is one of the reasons why it has been incredibly concerning for some investors who don't want to get invested so heavily in particularly data centers and other aspects. At the same time, these are companies with incredible balance sheets, the like of Alphabet, which issued a 50-year tranche. And we had on a guest earlier in this week who talked about how we did actually actually see buyers there for that, including herself, because of the duration. This is the reason why some people are still leaning into this debt, because of the cash balances of so many of these companies. Heading into next year, though, a lot of people saying that credit spreads are priced to perfection. You have seen credit spreads drop to some of the lowest levels that we've seen going back years. And frankly, people are looking at this and saying how much alpha actually is left. Right now, you're seeing high yield credit spreads ending the year at 2.67 percentage points over benchmark rates. That is one of the lowest rates that we've seen over in history. Going forward, one of the big questions is going to be how much you get volatility, how much private credit could potentially be a concern, especially given some of the opacity of that. And then, of course, the rate picture. And when you take a look at the rate backdrop right now, you do see yields just ticking higher because you are not seeing the jobs picture fall apart. Yesterday, we did get the Fed meeting minutes, and they showed that people were more concerned about the labor market and potential weakness there than in inflation. While inflation has still remained above 2% for 5 straight years, it has been ticking lower, and people point to things like the housing market that have been pretty subdued, that are not adding really to any of that inflationary pressure. When they take a look at that, they emphasize the labor market, which is the reason why you've got 2 rate cuts priced into the market for next year. Today, we saw jobless claims actually come in lower than expected. And right now, you are seeing a sell-off with 2-year yields up 2 basis points to 3.47%. The 10-year space also selling off to 4.14%. And you do see a steepening in the yield curve throughout the day. And this has been something that people have been talking about. Let's head over to Lizzie Burden right now to talk. Oh, excuse me, Lizzie is not there. But coming to the up on Friday, we are going to be speaking to Jeff Yu of BNY Mellon, who's going to lay out his look going forward, given the fact that right now people are still expecting another double-digit return for 2026. Jeff Yu of BNY Mellon will be joining us. Dan Ives of Wedbush, Peter Scheer of Academy Securities, Catherine Rooney Vera of StoneX Group, as we look forward to a new year. The key aspect is going to be truly economic data coming, given the fact that we haven't really gotten a clean read. Next week is going to be the new year. We're going to be getting ISM services, ADP employment, as well as, of course, the jobs report for December. That could potentially be the first clean read. The key aspect there is how much do you get an increase in the unemployment rate, something that Citigroup has been pointing to, given the fact that if you do get a 4.7% unemployment rate, even with this low hire, low fire dynamic, that could indicate that the Fed could move as soon as January 28th. One aspect that they highlighted in a note last night was as the balance of risks shifts more towards downside risks to employment and away from upside risks to inflation, we continue to expect 75 basis points more of rate cuts in 2026. That does it for me. It has been a wonderful year with you. Thank you so much for joining us on Bloomberg Surveillance. We look forward to seeing you bright and early in the new year on Friday. From New York, this is Bloomberg.